Hope everybody's doing well today. Hope you guys stayed out of the way of news. Yo, man, I pretty much bought the bottom of the NASDAQ. They stopped me out, couldn't trade because of news, and then they ran for 8 bajillion points. Sometimes it's like that, guys. Um, but I knew that news was going to happen. I had this forexfactory.com/calendar. Learned that from Goober Pile. Shazam. And guys, every morning I come here and I look at this. I'm checking out forexfactor.com and I'm not trading the news. Like the core PCE price index means absolutely nothing to me. Couldn't care less about it. Unemployment claims, I mean, obviously, I don't want people unemployed, but in regards to my trading, it has no effect. The only thing that I know for sure is that I don't want to trade into news. I don't want to trade right before that emotional reaction. So every morning I come in, I look for high impact, red boxes, medium impact, orange boxes. Guys, we have it at 9:45 and 10 a.m. today. Also at 1:15, we've got a little medium impact when FOMC member Mester speaks. So every day I'm going through there and I'm looking at it. I make sure I'm not trading into news, guys. And that's really the first advantage that I give myself. And then guys, I want to go to the tutorial section over here. Oops, I did that pretty fast, didn't I? Straight from the Nexgen education page, guys, there's two main sections. There's a software user guide. This is where you're going to find everything that you need to know about NinjaTrader, setting it up, stops, target scaling, all that wonderful stuff. And then there's the T3 Fibs Pro Trader indicator tutorials, guys. This is where everything that I talk about comes from. When I say there's no secrets with Nexgen, I really do mean it. A lot of people think, well, he's going to give us a little and then we're not going to get everything we need to be successful. And that's just not true. You will get everything that you need right in this classroom because everything that you need to be successful revolves around chart reading. Good morning, JW. And guys, the chart reads aren't difficult. The chart reads don't take a long time if you go through the process of learning them. And then once you learn the patterns, you're going to have to restrain yourself. Hey, good morning, Adriana. And guys, I'm not going to read this out loud, but I'm going to encourage everybody. Hey, Roku, I'm going to encourage everybody to read this little snippet on the psychology of trading. Because the psychology is really the biggest thing in trading. The patterns are the patterns, and they're not difficult in most cases. But what is a little challenging is doing absolutely nothing when there's nothing to do. So we're going to go through it today. Small classroom, it looks like. That's okay. And what we're going to do is we're just going to talk about the journey, I guess is the best way to do it. And what I'm also going to do, guys, is I'm going to give you the easiest path to take. You can fight me on it. I'm okay with that. It doesn't hurt my feelings if you do. But I'm telling you from experience, guys, there's an easy way and there's a difficult way. And I'm a big fan of the easy way. So one of the things that we're going to do, or actually I guess three of the skills that we're going to help you master, I like this slide. The first thing we're going to do, guys, is we're going to talk about chart reading. We're going to make you a chart reader. Nobody is a day trader. We all think we're day traders. We're not. We're chart readers. We are professional waiters, waiting for advantages so that we can enter the market. And chart reading is going to be about 90% of what you do, guys. 90% just sitting on your hands, staring at a computer screen, waiting for the rules to be met. 10% of it is going to be actually taking the trade when those rules are met. So we're going to focus this morning on a high probability trend trade. And I do this every morning, and I spend an hour on this trade for a reason. The high probability trend trade is going to give you the ability to understand three key concepts: where the market is likely to continue to be used for entry points, where the market is likely to go to be used for targets, and where the market is likely to stop to be used for not trading into areas that may stop the market. And then from these three advantages, you are going to be able to do the trade entry precision. Guys, we're going to talk about being able to get into the market where the market is most likely to continue. And you're going to hear me say that a lot. And that's really the focus of the first 20, 30 days with Nexgen is simply being able to pick off these great entries. Because once you can, it makes management easy. You can manage a trade based on a great entry. You can reduce your risk. You can maximize your profit potential. So this is what we're going to focus on this morning, guys. And honestly, repetition is the key to recognition. So I say the same thing every day. I really do. And if you've been in my classroom any time, this stuff should start to stick. Your step-by-step path to becoming a confident trader ASAP. Guys, post your trades in class. Post everything that you do in class, every chart read that you have, every trade that you take, every question that you can come up with. Post it in the room and let's have a conversation about it, guys. There's nothing that's off topic if it involves your indicators. There's no question that doesn't merit worth to be in this room. I want to answer everything that you have going on in your head, because if you give me the opportunity to do that, guys, you will find a little bit of clarity. So when you post your trades in the room, it's imperative that you tell me what you saw. Talk about your rules. Hey, good morning, Dwight. Talk about the advantages that were in place. Talk about what went right, what went wrong. Show me where you entered. Show me where you exit. And really give me the opportunity to talk to you about each and everything that you do and you see. Because it's like having a private session. It really is. We'll go through, we'll talk about everything, and we'll find a way to do it better if there's a better way to do it. The second thing, is using your spreadsheet, guys, your real-time spreadsheet, or track your real-time performance in a spreadsheet. Here's my spreadsheet, and it's just 3 tabs. There is the first tab, which is where you're gonna create a trade journal, and you're gonna put every trade that you take into this section. You're going to talk about what you saw, what you felt, whether it won, whether it lost. And then there's this giant note section where you're going to take the feedback that you received in class, and you're going to be able to have that. So when you go back and you study these pictures, which is what I'm expecting each and every one of you to do, when you go back and study the trades that you took yesterday, you're going to ask yourself, what worked, what didn't work, what was the feedback that I received? And what this does is it identifies, patterns in the market that are bringing you success, right? Here's a picture of the perfect trade that won. I love it. It feels good. Here's the picture of me breaking rules and the trade lost. Well, that doesn't feel good at all, and I really want to avoid that one. So every morning you wake up, and if this is, where'd it go? If this is the picture that you're looking at and you traded directly into a termination condition, we had the conversation in class about what that means and what the potential outcome of it is, then you wake up that next day and you're like, man, I am 100% focused on not trading into termination conditions. I'm 100% focused on getting the right entries. And that little bit of study, guys, each and every morning, it's going to set you up. It's going to prepare you for the day. You're going to recognize patterns that are bringing you success. You're going to recognize patterns that are robbing you of that success. And this is such an important part of getting to where you want to be. Recognition comes through repetition, guys. So you've got to get these pictures going. Your trade journal is great. Study it every morning. Every time you post in the room and I'm like, man, that's the perfect high probability trend trade, or every time someone else posts in the room, that is the best looking trade ever, every advantage is in place, guys, steal it, drop it into your personal trade setup looks. And what you're going to do is you're going to study this as well, and you're going to create that recognition through repetition. Your section has stuff for your personal trade setup looks. It has management things, chart reading things, termination conditions. And then if you go to the client trade section, well, then you've got entry sequences. You've got over 300 pictures of you guys using the software effectively, embracing advantages. There's a whole section dedicated to the NASDAQ. There's some wonderful management tools for you here, patterns that repeat themselves in the market, because all the market is repetition of patterns. And even a whole section dedicated to termination conditions, because that's really the most common mistake people make. So if you're using the spreadsheet, this is my page, right? This is where I did some work. This is your page. Your goal should be to make your page look like my page. Try and commit to 15, 20 pictures a day, guys, talking about everything you see, everything you're doing. And then we're going to learn the rules for when it's okay to trade. We're going to do it with the high probability trend trade. This is a trade that typically wins 70 to 80% of the time. This is a trade that creates confidence through the memory of success. This is not a trade that happens every 13 minutes. This is a trade that you'll have to wait for. But the idea is that through the high probability trend trade, you're going to become a chart reader. You're going to recognize advantages and you're going to learn to speak to yourself in terms of advantages. You're going to simulate, you're going to practice, you're going to put yourself out there in a simulated environment and you're going to break all the rules, I hope, because every time you break a rule, you drop it in the room, we get to reinforce the rules, we get to reinforce the looks, we get to look at everything that it does. And I really want you practicing the correct rules. I want you focused on having these advantages because simulator millionaires rarely do well in the live market. People that break the rules to get a big simulator number are not teaching themselves the muscle memory that it takes to be successful in the market. They're not trading the patterns, they're trading their guts. And we're going to trade patterns. We're going to simplify a lot, guys. We're going to simplify 2 trades. I'm going to give you a very rock solid plan for it. What looks will you commit to? You have to know the looks. You have to know what it looks like to have the rules met. And then once you have those looks ingrained in your head, guys, it really becomes easy to find these trades in the moment. Until you get the looks down, what you're going to find is that it's difficult to catch the trades live. It's going to feel like the market's moving fast. So I'm going to encourage you, take pictures and take lots of pictures. And don't just take them because Mark said take pictures. Take those pictures and talk about everything that you see. And one of the best tools that you can use is write your rules on the chart. And these are the rules for the high probability trend trade, guys. I'm going to teach you to police yourself. I'm going to teach you to recognize these rules, to be able to catch them in the moment. And all you're doing as a brand new user is you're developing trust in the methodology through study, through repetition, through simulation. The high probability trend trade is only 3 rules. And each rule provides an advantage here in yellow. Rule number 1 gives you the advantage of momentum, a market that's likely to continue in the direction of the trend. Hey, good morning, Miss Cindy. Rule number 2, hey, Mario, will give you a clear path, meaning that you'll have room to get to your targets. And then the final rule is designed to get you in where the market is most likely to continue, to give you the advantage of pinpointing with unbelievable precision where the market is likely to continue. We're going to focus on these 3 rules. We're going to talk about them. We're going to identify them. We're going to piece them together to create a trade. And we're going to do it with only 2 charts. Once again, simplicity. You're going to see people in this room with more charts. You're going to see people in this room with different charts. You're going to see people taking trades that don't fit these rules that I'm talking about. I want you to resist the urge to be the trade police. I want you to resist the urge to be a 2-year trader when you're a 2-week trader, right? Get the basics down. So the large chart is always going to lead the way. The large chart is a slow-moving chart. It is that loaded down freight train, and it's hard to change direction. The large chart is going to define the direction of the market. If the large chart says we're going up, you guys should be looking for rules to be met for a high probability trend trade long. That's buying the market. If the market is telling you that it's going down, you should only be looking for high probability trend trade short. That's selling the market. One of the great things about futures is that you can make money both directions. The large chart will define momentum. Rule number 1 is designed to show you that momentum, to let you know that that advantage is present. It's also going to define areas, the areas that are problematic and the areas that are now in our rearview mirror. That's rule number 2, and that's going to provide you room to your targets with a clear path. Once these rules are met, and only when these rules are met, we're going to take that large chart, that most current bar on a large chart, and we're going to create an X-ray of it with a smaller, faster chart. We're going to look at 15 to 30 bars worth of information that's happening inside this one slow-moving bar. That allows us to enter the market where the market is most likely to continue. That gives us the opportunity to pinpoint our entries, to reduce our risk, and to maximize our profit potential. And rule number 3 is designed to be so specific that you're going to use a limit order. You're going to wait for the market to come to you at an area inside of triggers on a smaller, faster chart, and you'll be able to piece it all together to create a trade. So a trade is nothing more than momentum, a clear path, in an entry area, and that is the high probability trend trade. That's the trade that's going to create confidence through the memory of success. This is your focus until this becomes easy. And honestly, this is going to become easy pretty quick. And then we're going to add a second trade. And then you may add a third, fourth, fifth, and sixth, but I'm only going to give you a plan for 2 to keep you focused in the beginning. So 3 rules, 2 charts, and the large chart is going to start by defining direction, guys. If the background is green on your large chart, it's going up. You should be going up too. It's like a lazy river, guys. If you've ever tried to walk against a lazy river, it's not easy. If the background is red, the market's going down. Look for opportunities to sell the market. Don't fight that trend, because the trend's created by the people that move the market. And one of the hardest things for people to accept is you're not the people moving the market, guys. There's this large crowd, these deep pockets investors, they're going to push on that large chart. You're going to see them establish the trend. You're going to see them establish momentum. You're going to see them react to these key areas. And then we get this small crowd. That's us. We're not even these guys, honestly. These guys create a little pushback. That's us inside of this circle waiting to pinpoint and take the perfect entry, to trade with the trend, to trade with direction, to trade with momentum. So once the large chart says up or down, that's which way we're going. And that's the only way that I can have strong triggers. Rule number 1 says the large chart must have strong triggers. Strong triggers in an uptrend. It's imperative that the small triggers and the large triggers, solid lines, dashed lines, are both green. If they're not the same color as the background, you do not have strong triggers, and rule number 1 isn't met. How easy is that? And then strong triggers means that the small triggers are up and above the large triggers. The space between the two, you guys see that? Looks like scissors that just opened. It's the space between the two that lets me know that the odds are favorable for the market to continue up. Odds favorable momentum, that's your first advantage. And you're going to see it annotated on charts all day long. OFM, odds favorable momentum. So every time you look at a chart and you see this look, I want you to say to yourself out loud, I have momentum. I have rule number 1 met. To the downside, the background is green, or red, excuse me. So the small triggers, the solid lines have to be red. The large triggers, the dashed lines have to be red. My scissors have opened, space is created. This is a strong trigger look. This is rule number 1. And guys, when I have strong triggers to the upside, I'm going to buy a pullback on that smaller, faster chart to Fibonacci support. When I have strong triggers to the downside, I'm going to sell a pullback to Fibonacci resistance on that smaller, faster chart. This is your first advantage, guys. Strong triggers can break areas. Strong triggers push that market in the direction it's going. Strong triggers will even cover some of the mistakes that you make. Pretty much every trade, good morning, Cav, that Nexgen teaches revolves around understanding the advantage of momentum. Whether it's a large chart or a small chart, separation between the small and large gives you an advantage. Is everybody cool with this look? Strong triggers, guys, this is rule number 1 defined. And then eventually those small triggers work their way back inside of the large triggers. I love the laser pointer. And when they're inside the large triggers, anything can happen up or down, guys. That is the opposite of having your rules met. Some might even say that's your rules not met. Anything can happen up or down is a horrible, horrible way to risk your money. So odds favorable momentum doesn't sustain forever. When you have that OFM, that best of the best, guys, we are selling pullbacks to resistance like we're getting paid to do it. And 70-80% of the time we are. And then when both triggers are down and one of them get inside the large, well, this is the first sign of a slowdown. Short trades can still be taken with that downtrend, but you are losing momentum. It's imperative that your smaller chart agrees. And then with both triggers down, inside of the large, that's that weakening, that slowing of the trend. Anything can happen is the term that you're going to hear me say all the time, guys. Well, you had anything can happen triggers, and sure enough, anything happened. It took you right out of your short trade. Anything can happen triggers when they hit Fibonacci support or resistance. That's a pretty good look that the market's going to stop as well. So odds favorable momentum. Let me see if I can minimize this. It's not going to let me minimize it. So what I'm going to do is I'm going to pull up a large chart real quick. That's crude oil. And let's just go through and look at it, guys. Strong triggers to the upside, strong triggers to the downside. All I'm going to do is I am going to create recognition of strength. Strong triggers to the downside. You're going to see on the charts when you have strong triggers, these little tails or these wicks. Guys, these are the pullbacks on the smaller, faster chart that we're looking to enter at. You're literally going to be able to pinpoint where the bottom of this tail is most likely to form or where the top of this tail is most likely to form. But is everybody, can you give me a why in the room other than Arturo? He already gave me one. This is rule number one being met. To the upside, to the downside, to the upside, and look at how the market continues almost every time we have that momentum. Sell a pullback, sell a pullback, sell a pullback. Guys, let's get paid. Odds favorable momentum. It should lead the way. Odds favorable momentum should be the one thing that you refuse to do without. And understand that when it's gone, so is your momentum. So the large charts, what has it done for us so far? The large chart has defined the direction of the market. The large chart has also told us, do you guys see it? Smalls above the large, the scissors are open, the space is created. Large chart has defined momentum as well. The advantage is in place. So I'm going to look for rule number two, guys. And rule number two says, don't trade into a termination condition. Don't trade into an area that has the potential to stop the market. Termination conditions are nothing more than where that large crowd reacts, guys. The people that move the market know where these lines are. And not only do they know where they are, they might enter at a line, they might exit at a line, or you may find yourself where buyers and sellers just duke it out right at a line because one side wants it to go up, the other side wants it to go down. Guys, it's like two pit bulls in a small cage and you are a big slab of ribs, right? Don't be there. Don't get caught in that fight. So what we're going to do is we're going to identify when we need to step back, when we need to get out of the way, when we need to let those decisions be made. And that's going to let us know that we'll have room to our targets. So we've defined direction, we've defined momentum, and now we're going to define the areas, guys. So a termination condition is a Fibonacci-based indicator that may reverse the market. This is based on a comparison of the Fibonacci area, Fibonacci support, red Fibonacci resistance, yellow 1-to-1 dots, cyan divergence low lines, which means that there was a loss of momentum off of a low pivot, a magenta divergence high line. It means that there was a loss of momentum at a high pivot. We're also going to look at any third divergences in the same area, and I'm going to show you when that large chart midband can behave as a termination. It's this cool little thing that we call the gap theory. So these are your areas. And then guys, the recipe is simple. If price reaches an area, because remember, this is where decisions are made. So if price reaches Fibonacci support, check your trigger lines. If they remain above the area of support, no more short trades on that small chart. We're not looking to buy a pullback on the small chart. This is an area that may stop the market. This is an area that may reverse the market. It may create an untradeable bounce, or it may just set off a fight that we don't want to be a part of. Guys, the recipe never changes. Price reaching the area is the catalyst for decision making. The trigger location is going to let you know whether or not you should be trading into it. This is a termination condition. If your small triggers get a couple points beyond a problem area, price reaches support up here, the triggers don't break, let's wait, let's see what the decision is. If the small triggers get a couple points beyond that area of support, but the large triggers haven't broken it yet, and all that momentum is present, this area has the potential to break. Guys, strong triggers break areas all the time. The area is not considered broken until both the small, both lines, and the large, both lines, have gotten below this area of support. It begins to behave as resistance. Does that make sense, everybody? No triggers, no trade. Both sets of triggers, the path is now clear. And as long as that most current bar hasn't reached the next area, it is game on. I'm looking for momentum. And I'm going to sell a pullback to resistance if I have it. And that's where you're going to pinpoint the highest probability trend trade that you can take, guys. That's the best of the best with a clear path and all this momentum. That's the one that loves to run down to that next Fibonacci area. Remember that 90% of your day is spent waiting, guys. Price reaches Fibonacci resistance up here. Perfect termination condition. The triggers remain below, and there wasn't one person in this room that said, man, I really got to go long into that line. And thank goodness, because it pushes all the way back to support and all the way back to the midband. This is what we call the gap theory. If price accelerates away from these large triggers and smacks into an area, midbands, fibs, anything, price is likely to close that gap back to the large triggers. This is the look that gives you the midband as a termination condition. If your large triggers are a full bar away, don't take shorts into a midband. If price reaches support and the triggers remain above, don't take shorts into that area of support. I can't go long and I can't go short, and the market heads back up and it hits two lines of resistance. And guys, there's one of those divergence highs. This line where it forms isn't a termination condition. When price reaches this line and the triggers remain below, that's a termination condition. So you're actually looking at 1, 2, 3 terminations in the same price range. Notice how weak the triggers are into it. The smalls are actually below the large. This is an area likely to stop the market. This is what we call a pivot stop out. When price trades above a divergence line and then price is back below that magenta line, don't take any long trades. This is literally a line in the sand from the sellers saying, I dare you buyers to push back up here. We are going to unleash on you. And when it happens at fibs, it adds a little power to the top. And then finally, momentum. Everything is screaming down. Strong triggers break areas, smashes right through support, and then it reaches these yellow 1-to-1s. And when it does, once again, you guys are so smart. You're like, whoa, all my triggers are above that area. Let me sit on my hands and see what happens. And then once again, you are not liberated from your cash, because look at the push from the buyers right off of that key area. And you're going to see this a lot, guys, where price stops darn near to the tick at these key areas. The buyers push it up. It hits resistance. The triggers remain below. Now you guys can't go long or short. And you're thinking, man, when am I ever going to make money? And the sellers push back, so thank goodness you didn't go long. Notice that the trigger line colors don't match. Triggers above support that had been reached, triggers below resistance that had been reached. Guys, this fight carries on for 45 minutes. Midband reached. Large triggers a full bar away. Look at that. The midband holds. Eventually, the buyers went out, and all the triggers get above resistance, and now it's behaving as support. The small triggers are outside of the large triggers. I have momentum, and each and every one of you in this classroom that sat there for 45 minutes waiting to get paid just entered the market on a pullback to Fibonacci support inside of favorable large triggers on your smaller, faster chart. You got in at 81.05. You got out at 81.49, right at that key Fibonacci area. And guys, that is $440 worth of profit per contract to get you up to that position. It's what you don't do when the advantages aren't present that allows you to keep the money you make when the rules are met. And that's really the focus, guys, is just speaking in terms of advantages. Do I have momentum? Yes. Did price reach an area, the triggers stay above? Yes. Dag nabbit, no short trades. That's it. It's that simple. Sometimes on that slow moving chart, the market turns from nowhere. You may have a clear path. It might be weak triggers and you're thinking, man, I really want to go short. And then sometimes you'll even have odds favorable momentum, didn't reach the fib, and you're like, whoa, I can't wait to go long. Guys, this next termination condition is going to help you identify when a market may be changing that you can't see on that slow moving chart. And it uses those losses of momentum, those divergence lines that print from pivots, letting you know that the buyers stole the momentum from the sellers or the sellers stole the momentum from the buyers. Because 3 divergences in the same price range may terminate the trend. I said may. It might. It could. It's likely to. But it's not guaranteed, guys. All we're doing is we're trading patterns. 3 divergences in the same price range has happened enough that it has been proven over a time period that it's likely to reverse the market, at least momentarily. It's very powerful when your small triggers get inside of the large triggers. Remember that anything can happen look? So visually, I see 3 losses of momentum. I also see, I'm reading my indicators, that loss of momentum on the small chart as well. And then it becomes even more powerful when that third pivot's higher than the previous from a low or lower than the previous from a high. Guys, this is the look at a low, and this is the look at a high that's going to let you see this change, that's going to keep you out of that last short, that's going to keep you out of that last long. You're also going to be able to use this for management. 3 divergences is a termination condition. 2 divergences, when the second is higher from a low or lower than from a high, is going to be a management opportunity to help preserve equity. And we'll look at that before the day's over. We will talk about management, but first we're going to get entries, guys. Let's figure out how to pinpoint where the market is most likely to continue, because rule number 3, when the rules are met on the large chart, says that you're going to use a limit order, meaning that you're going to wait for the market to come to you, guys. You're not going to run head first at the bus that's coming to pick you up. You're going to stand at the stop and wait for it to open its doors. You're going to use that limit order at an area. Fibs, midbands, and yellow 1-to-1s, guys. Areas on the large chart said no more trades. Areas on the small chart say let's give it something to bounce off of and continue with that momentum and clear path. And the key is that we're going to let those areas be inside of favorable large triggers. They're going to be inside of those trigger lines. So leading up to the entry, large chart has momentum. It's going up and it hasn't reached an area. And I really want to make sure that you guys are comfortable with this, because this is what it's going to look like on the large chart when it's time to look for a long trade. Background is green, triggers are green, scissors are open, haven't reached resistance, and we have cleared the previous resistance. Guys, give me a Y if you're with me. This is a picture you should commit to memory, because that is the money shot right there. Once you have it, we're going to go to a smaller, faster chart. We're going to refine this big, broad stroke of a brush, and we are going to find the best of the best spot for entry. So when everything is up, strong, and clear, you're going to figure out, and you're about to learn how to buy low, how to get in at the lowest point, at the best spot, at support, and then carry that momentum to resistance. And of course, if everything is going down, we can make money that way too. We're just going to sell high at resistance when everything is down. That refinement process looks like this, guys, and this is hard for users because you're going to hear me say these tails on the large chart. Do you see the tails on the large chart? Guys, we do not trade the tails. We're going to use these tails to go back and study. We're going to use these tails to see where the market pulled back with odds favorable momentum, but we are going to use the dissection of that one bar. The lowest point of the most current bar is going to be the beginning of a pullback on a smaller, faster chart. The highest point of that one bar in a perfect world is resistance inside of favorable large triggers. We're going to pinpoint this spot so that we can continue with everything that this market says. It's going to increase room to your targets, and it's going to teach you how to sell high, and it's also going to show you how to buy low. So there is a, what's the word I'm looking for? There is a recipe, I guess, for picking your entry spot. Remember, the large chart has to say up. The large chart has to say clear path. The large chart has to have momentum. So on your smaller, faster chart, guys, we're literally going to wait for a reversal bar. We're going to wait for the market to start pushing against everything that the large crowd wants to have happen. Thank goodness for these little kids with some money to create the shove, but they rarely make it. So once the reversal bar prints, I have to do 2 things. The first thing is I have to look for my trigger lines. Your large chart has, or your small chart has 2 sets of trigger lines. It has a large trigger, the smooth trigger. That's the one that you'll use to gauge the momentum on the small chart, the separation between the two. We all know that look. It's universal. It means momentum. And then there's these synthetic triggers. These are just the large triggers from your large chart. That's all they are. But the cool thing is that when these trend one on top of the other, like snakes kind of ride and piggyback, Guys, it creates what we call favorable large triggers. And what it does for you looking for an entry is it gives you the smallest possible location where those areas can reside, because your areas have to be inside of the trigger lines. Mid bands, yellow 1-to-1s, and here I have a blue fib, but it's not inside of the trigger line, so that's actually not going to be in my window of opportunity. The window of opportunity, the area where the market is most likely to continue, extends in a long trade from the highest point of support, this mid band inside of triggers. I want you to say that every time you look for an entry, to these yellow 1-to-1s inside of favorable large triggers. The lowest point, that's cyan shaded area, this is where the market should continue with all that momentum, where it should continue with that clear path, where it should continue with that direction. And guys, your job for 20 days is to define this window of opportunity and just put a limit order at the top of the window. I want you to be okay if it doesn't work. I want you to be okay if you fudged a rule, but I want you to show me and write on your chart where you're getting in, where you've defined your window, because what happens is these ultimately create very manageable trades. When we're going short, I'm going to wait for the reversal bar. At the time of the reversal bar, I identify my triggers, large and synthetic. The tighter they are on top of each other, the smaller my window becomes. And then I'm looking for lines inside. I'm looking for fibs, mid bands, and yellow 1-to-1s. This is kind of one of those rare occasions where there is one line inside of those favorable large triggers, guys. My cyan box is tiny, and my limit order goes just below that mid band, a tick or two. And I'm into the market with odds favorable, momentum, a clear path, and now I have entered exactly where the market is most likely to continue. These fibs, these yellow 1-to-1s, are outside of the triggers, therefore they are not a part of the window. Is everybody cool with what we're talking about? So we're going to put it together. Large chart says up, right? It's green. Large chart says momentum, the scissors are open. Large chart hasn't reached the trouble. It's clearing the trouble below us. And you're just saying to yourself, man, let's look for a trade. So we turn our attention to the smaller, faster chart. The reversal bar prints. Large triggers, synthetic triggers, they're a little spread out, so my window has the potential to be larger. I'm activating a limit order just above the highest point of support. I don't trade the tail. The top of this bar is the beginning of my pullback. The bottom of this bar is support inside of favorable large triggers. You're going to be able to go back and circle these tails on a large chart and see if the rules were met for entry on the small chart. And if they were, it's a high probability trend trade. You'll also notice that there was only like 4 ticks to get to that trouble spot. But because we know how to buy low, that $40 turns into $250, guys. We create the opportunity for a lot more profit by waiting for the pullback. There it is again. Everything says up. The path is clear. My rules are met on the large chart. Reversal bar prints. I identify my triggers. I've got a tiny little window of opportunity, and my entry is just above that mid band. One of the common mistakes, and we saw it earlier, and we're going to talk about it because it's an awesome picture, is I see people jump in at the triggers, not at the areas inside of triggers. I see people going, well, it hit the triggers, let me get in. Guys, by waiting for the areas, the triggers are where we anticipate it to correct to. The areas give it something to bounce off of. It's like a brick wall and you're throwing a tennis ball as hard as you can. And triggers are like clouds or fog. You're going to throw right through the fog, but once you hit that brick wall, it gives it the opportunity to bounce and go off to that target. And understanding where the market is likely to continue gives you the ability to understand where the market should not go. Your rules are defined through rule number 3 to create this window of opportunity, to let you know exactly where that market should bounce. So 4 to 5 ticks above that window is where your initial stop is going to go, guys. Every trade is going to have a protective stop if you're an intelligent trader. Every trade is going to have an area where you say, you know what, that's it, I'm out, I no longer have the advantage. 4 to 5 ticks above The window of opportunity is where that advantage goes away, guys. We can minimize our losses. We minimize them through having momentum, through having a clear path. And now because you know where the market is likely to continue, you can minimize your losses by having a stop 4 to 5 ticks above. Guys, sometimes the stop is 7 ticks, sometimes it's 17 ticks. But understanding your window, the tighter the window, the least amount of risk you have. It lets you define where it's time to cut ties, to get out of that trade. And I'm going to tell you right now, and I want you to listen, especially all my new people, you will take losses. I promise you, you will take losses. You'll have days where you go down money. You'll have days where you'll take 3 losses in a row and you stop trading. Because every 100 trades you take where the rules are met, you're going to lose 20 to 30 of them. It's a normal part of a positive equity curve. It's a cost of doing business, which is one of the reasons why we focus so heavily on making sure that we have those advantages, that we put our stops where it's appropriate, and that we accept those stops and take our emotion out of it, because the reality is there's going to be times where you might lose $20 or $30 on a trade rather than blowing out 200 or 300 because you knew where the market should stop. You knew where it should bounce. And once it gives you a reversal bar in the direction of your trade, you'll put a stop just below it because it's already done everything it's going to do. Guys, this is one of the great things about this 2-chart system is it's giving you the opportunity to really put it all together, to take a slow moving chart that's all the advantages you could ever hope for. Strong triggers, clear path, and then just refining it down to the smaller, faster chart. Guys, it takes time. It takes time to recognize this in the moment. Whoops. I should have noticed that dropped out on me. Your spreadsheet gives you the opportunity to study these looks when nothing is moving, right? So the more you see a picture with momentum, with a path clearing, with a pullback to support, the easier it becomes to catch it in a live market. The more you see a market coming off of a termination condition, everything says up. Look at how he snipers this entry. Bing, bang, boom, there it is. And off it goes to targets. So I said yesterday, I said, guys, take a lot of pictures. And because I'm not the kind of guy to give homework and not be willing to do it myself, I did some homework this morning. And I did it for you guys, and I posted it in the room, and I wanted to show you why I tell you to take so many darn pictures, why I keep saying over and over, guys, take pictures of everything you see. Annotate your charts, write your rules. I went back and I found 3 pictures of strong triggers that had a tail. Strong triggers up, buy a pullback. And I didn't just take a picture and then get on with my day. I took the time to type out what that means to me, what the advantage is. Strong triggers, buy a pullback. Strong triggers up, buy a pullback. Strong triggers up, buy a pullback. So what I'm doing right now, and guys, I love a little feedback on this one if you don't mind. Give me a Y in the room if you see the strong triggers. Doesn't this look like this look like this look? Guys, if you look at 50 pictures of strong triggers, you're never going to miss strong triggers. You'll have absolutely no doubts what it looks like. Or to the downside, look at it, strong triggers. It looks the freaking same, right? Guys, this is rule number 1. This is you saying to yourself, I know exactly what I'm looking for rule number 1 to be met. And if you can't find it in the moment, keep looking at those pictures, guys. You're going to get it. 50 pictures of strong triggers will take you 30 minutes of study. After 50 pictures of strong triggers, you'll never miss strong triggers. And then it's time to take those strong triggers and make sure that they didn't hit an area. Because if price reaches an area and the triggers remain below, no more longs. This is a termination condition. I didn't just take a picture of the termination condition. I wrote my rule. I wrote what it means to me. If price reaches an area and the triggers remain below, no more longs. This is a termination condition. And then once again, guys, all I did was scroll back and I could see those. And if I can't go long, then I can't go short. So what I'm doing is I'm committing these pictures that are still so that when the market reaches a termination condition, I'm not fooled into thinking that I have a clear path. Because a clear path is when both the small and the large get above resistance, it's now broken, and you'll look for room to the next area. And if the small and the large get below support, it's now broken, and you'll look for room to the next area. And then finally, if only the smalls break with strong triggers, that's crazy. Here we go. The area has the potential to break because of the strength, but it's not broken. The path isn't clear. And I'll tell you guys, this one ended up going up from there. And if the smalls break with momentum, the area has the potential to break, but it's not broken. It's not a clear path. Rule number 2 isn't in place. It can't be a high probability trend trade. And you can see it right there. Look at that big down bar. That was just a little bit of overrun. And that's your second trade. That's the 50-50 trade, where you have momentum and you may have an entry area, but because you don't have a clear path, you're going to have to manage a little more assertively. So guys, when I ask you to take pictures, right? When I say, hey, go take a lot of pictures, fill up your spreadsheet, that's why. It doesn't take any time. All you're doing is you're committing these looks to memory over and over, so that when the market is open, you can say, I had weak triggers and 3 divergences, I'm not going long. And that's how quickly it can happen. I do have strong triggers. And this area has the potential to break. So if I'm going to take a short, I'm going to take it from an area inside of favorable large triggers. But because the area is not broken, this can't be a high probability trend trade, which means that I have to manage it assertively. Which means that maybe I take a profit at the first trouble spot. Maybe I'm looking for price to reach the next fib, but I understand that this is not the best look because the area is not broken. But I do know strong triggers breaks areas, has the potential to. I do know that strong triggers aids in that. And I can identify where the market is most likely to continue. I know where the market shouldn't go if it's going to work. And I can decide through my chart reading whether or not I accept the risk for this medium probability trade. Does that make sense, everybody? Is it going to give us a reversal bar? What do you think? I don't know. It might not. There's just no telling. $41 represents a $100 move. 31 represents a $200 move. Guys, this is what we're going to talk about. There's my reversal bar. I'm going to reduce my risk. Guys, we just took a medium probability trade. We just hit our first target, and now I'm going break even. I'm not going to let anything bad happen to me. That area is still not broken. Does everybody see what I've done here? I've entered at the best spot. I've taken quick profits because it's not high probability. And now I've got a $200 target. And if I were really being conservative, I would just get out at the divergence low because this area is not broken. And divergence can kill that because I've already sacrificed a clear path. Why on earth would I sacrifice momentum as well? So I'm going to close out of that one real quick. And who knows what it's going to do? I don't know what it's going to do. It doesn't matter. It's simulator. We're only learning to pinpoint where the market is likely to continue. We're looking for strong triggers. Strong triggers by a pullback, right? What does that tail look like on a smaller, faster chart? Looks like a pullback to support right inside of triggers. This is what we're studying for 20 days, guys. People ask me all the time, does the software work? Guys, the software is freaking flawless. The flaws come from us when we create opinions, when we try to break rules. So one of the things I'm going to do is I'm going to give you guys a very solid plan that focuses initially on the high probability trend trade. Learning to look at your chart and just speak to yourself in terms of advantages. Every time you look at a chart, you should go, hey, I do have momentum. I don't have a clear path. So as a brand new user, maybe I'm not taking this entry, but as an experienced user, I'm going to take this entry and I'm going to manage it aggressively because both triggers haven't gotten below the area. And then I'm going to go to another time frame, and I'm going to say, hey, look, weak triggers, multiple divergences, and I'll be darned, it continues to push down. My rules kept me from trying the long, and now I'm into support, but all my triggers are above it, so I can't go short. But I don't even have triggers up. I can't go long. Guys, 90% of your day is spent waiting. And there's crude oil again. And sure enough, the area didn't break, and off it goes towards the moon. And I'm going to open up my S&P. Oh, I'll tell you what, I'll open up my NASDAQ chart. And while I'm opening up my NASDAQ chart, guys, I'm going to introduce you to the KISS plan. So the KISS plan is your stepping stone, guys. It's the stepping stone in your learning journey. And I give this out every day. Every day I give you guys this plan. I have had people fund those prop firm accounts within their first 30 days with Nexgen by keeping it simple and keeping it focused. I've had people that have gone off and try to catch all the trades, come back to the KISS plan and find success. I've had people that are trying to catch everything and catching absolutely nothing. Come back to this KISS plan and find success. And I'm going to tell a story because I feel like telling a story right now. I had a gentleman, and he's off trading successfully now. And one day in class, right, called me out in front of everybody, put a spotlight on me, and he said, Mart, these trades don't happen the way you say they happen. These trades don't happen like you say they do. And I said, okay. I said, that's fair. And guys, I want you to question me. I want you to question me every time. And if you're frustrated, I definitely want you to question me. So I said to him, I said, all right, so let's look at some of your trades that you're taking. And he was taking trades without momentum, and he was taking trades without a clear path. And he was taking trades just from all over the place and not following any rules for entry. And he basically said, you're full of shit, Mart. Pardon my French, everybody, with delicate ears. And again, I'm okay with that, guys. I want you all to assume that I am, but I want you to do the work to prove that I'm not. And I said to him, or her, them, right? I said, do me a favor. I said, give me 5 days. Give me 5 days with the KISS plan. Give me 5 days of keeping it simple. Give me 5 days of optimizing your chances of success by following a very concrete, proven plan that has been working forever. And I said, and after 5 days, I want you to call me back and I want you to tell me if I am in fact full of shit. And it was 7 days before I heard from him. And he came back and he called and he goes, hey, Mark. And I'm like, yeah, what's up? He goes, so it turns out if I follow rules, I'm finding all of these trades. If I'm not chasing all of the trades, I'm successful. And he was at 74% winners, I think, with this plan. And he said, you know what? It's kind of funny. He goes, I thought I was so smart. I thought I was going to outsmart the market. He goes, but once I kept it simple, I found success. And I liked sharing that story because I think there's a lot of people that are in the same boat. There's a lot of people that go off and try to do their own thing. And when it doesn't work, they believe it's the market or they believe that it's the software. And the reality is more often than not, it's us, guys. So focus on rule adherence. This is going to give you the best chance of success with that area with the potential to break and that high probability trend trade. And all you're doing is defining your entry initially, right? Don't fight the large chart. You can't get the best entry if you're fighting the large chart. That should be your number one rule, guys, because this keeps you out of 70%, give or take, that don't win. Like 70% of the losers. It just eliminates. And here's a checklist for getting into the market. And if you can mark yes to each and every one of these guys, I've never had anybody do worse than 70% ever in the history of the checklist. I don't think you'll be the first, but you have to follow it to be able to prove that. And then once you enter the market, guys, great entries create manageable trades. Great entries allow you to take advantage of that great entry through low risk. So the management plan that's put together on the KISS plan, the Keep It Simple Sunshine plan, is 100% focused for that high probability trend trade. on getting in where the market is most likely to continue, understanding that entry. So if you're uncomfortable with entries, you and I need to talk extensively every day about those entries until it's second nature for you. Because once you understand where the market is most likely to continue, you understand where it shouldn't go, and you start becoming comfortable with putting your stop where the market shouldn't go. Once you're in there, there will be nothing for you to do. The only thing that you can do really is wait for a reversal bar or get stopped out. But if you get the reversal bar, we're going to reduce risk. The same way I did it live for you just a few minutes ago. I'm going to go a tick or two above that reversal bar because what I know with no uncertainty is that now the market's doing what the market said it was going to do. The market said that it was likely to go down because of momentum and a clear path. I came in at the bounce point. It's starting to do it. I'm going to minimize risk, guys, and I might get stopped out here. I really might. You never know. I don't know. I never know what's going to happen in the market. All I know is that my rules are met, and my rules are based on a pattern that has been proven to win more than it loses. If you don't get stopped out and it goes to the first target, it's this little $100 shot. Boom, bam, $100 in your wallet. Life feels good. And then once you have that $100, it eliminates an awful lot of fear because you're like, whew, I just got paid. And you're going to move your stop to break even. You're like, I've got nothing to lose and money in my pocket. Egads and little fishes, let's hold for the second target. And your second target is only $200 away, guys. Which means with the advantage of momentum, with the advantage of a clear path, with the advantage of having entered where the market is most likely to continue, you just captured $300. $300 a day is $72,000 a year. That's not a bad little supplement to the income from one successful high probability trend trade. Hell, hit break even 3 times a day. Make $100 and get stopped out break even. It's $72,000 a year. Everybody thinks you have to hit home runs. Everyone feels like, man, I got to make $500, $600, $700 on a trade or it's just not worth my time. Utter crap. Get paid, guys. That's the only reason that we do this is to get paid. So your simulation, your study, your feedback, continuous practice, guys, you're going to create a plan that's tailored to your goals. You're going to understand the advantages, and you're going to start taking trades that are outside of this KISS plan. You're going to recognize all these advantages, and your repertoire is going to grow should you decide it needs to. Management is no different, guys. Eventually, you're going to create a plan based on your experience. And let me show you a cool one. Where you were getting $300 at first, you're going to begin to recognize momentum. You remember that from your chart reading? And you're going to begin to recognize a clear path. Once again, chart reading 101. And you're going to say to yourself, with momentum and a clear path, because I've seen this happen so often, I'm going to hold that last contract. I'm going to hold it down here at Fibonacci support, and I'm going to turn that $300 trade into a $700 trade. But all you have to do is start learning your rules, start understanding your advantages. This is an area with the potential to break. This divergence says that entry is absolutely ridiculous. 50-50, one area not broken. Don't give up momentum if you don't have a clear path, guys. It's right here in the KISS plan. Eventually, you may adjust it. But for now, keep it simple. Keep it focused. Take the best of the best. Your money's worth it. I promise you. Your money is worth it. So I'm going to drop this KISS plan in the room. This is for you. Enjoy it. I'm also going to drop my spreadsheet in the room. So you can have all of those examples on there. When you look at the spreadsheet, whoops, I accidentally closed it out. When you look at the spreadsheet, under the work that I did for you guys, client trades, there's an entry sequence for shorts as well as longs. There's your management sequence. All of these trades that were taken by Nexgen users, make your section look like mine, guys. And every picture you take, if you take a picture of a 50-50 with divergence, take a picture and say rules not met, divergence printed. Remind yourself that you're trading advantages, right? 50-50 with divergence, rules not met. Had to manage out of it. And Joel, you're absolutely right. It was a great example of a medium probability trade. It was the perfect entry that reduced risk. I think it was the perfect area. If I see a line and the triggers aren't through, that area is a bad mamma jamma. If I see lines and the triggers aren't through, that area might as well be a giant brick wall to me. So if I sacrifice momentum, that one doesn't fit the KISS plan. But because it comes from a good top, you might be willing to take a shot. Manage aggressively. Second higher divergence says GTFO. Thank goodness it did, right? Pushed all the way up to resistance where not one trigger line broke through. Guys, you're going to see this when a market is trying to consolidate. From resistance to support. I can't go long and I can't go short. Let's wait and let them fight it out. See what happens. Weak triggers. It's still dancing. If you don't think decisions are made at key areas, look at your small chart. Watch this. This is kind of a cool trick, I think. From the top of the red bar to the bottom of the green bar, that's all the bars inside of those two bars. If you don't think that there is a fight between buyers and sellers happening at key areas, go back and do this on a couple charts. It'll absolutely floor you. We don't have to be a part of that fight, guys, because our rules aren't met. One more. Let's look at crude. Darn termination conditions. Don't you just hate it when price reaches an area and the triggers don't break? 3 divergences in the same price range. Who went long hoping that this would produce something for them? Because there's always somebody. That would have been me all day long. But now this termination's creating a reversal. This reversal starting to give me momentum. Oh my gosh, guys, this may be the top of the market. We may find ourselves with a little pullback, maybe smack into some triggers, and possibly giddy up down to the next key area. I still don't have odds favorable momentum, so it's just a little bit soon. We just have to wait and see what happens. So guys, are there any questions about high probability trend trades? Are there any questions about momentum? The idea that strong triggers save lives, right? The idea that the only thing that you need to focus on initially as a brand new user is making sure that this is your look, making sure that you have the absolute best of the best, that you have a market that's likely to push, because momentum is the reason for the season. And then once you have that momentum, all you have to do is understand that if price reaches an area and the triggers don't break, it's okay to sit on your hands and do nothing. We've established direction. We're learning to establish areas. And then once you have that, once the path is clear, once the momentum is there, let's learn how to use that smaller chart to pinpoint where the market is most likely to continue. Let's learn how to reduce risk, how to maximize profit potential. And guys, if that's your only focus for 30 days, you will find success if you do the study. We always joke, the one thing that Nexgen can't give you is experience, guys. I can't force you to study. I can't force you to take pictures. I can't force you to participate in class. But if you're serious, if you really want to do this, guys, this is $1 million endeavor. Roll up your sleeves, get a little dirty, get the work done. And I'm telling you right now, take advantage of having someone here 15 hours a week whose only purpose in life is to give you feedback on everything that you see. So that's the first hour, guys. It's 10:04 a.m. and I'm going to go stretch my legs. So if you guys will do me the honor of posting pictures if you've taken a trade. If you've never posted in the room, how about if you go back and take a picture of a termination condition right on your chart? Mark, I think this is a termination condition because price reached an area and my trigger lines didn't break. Price reached an area and my trigger lines still haven't broken. So I'm not going long yet. No matter how enticing that bounce is. And guys, this is how you get to where you want to be. So I'll see you in 5 minutes. I'm going to go stretch, refill my water. Post them if you got them, guys. Is it just me or was that termination conditions for the win, guys? Oh my goodness gracious, great balls of fire. Guys, if you don't think it works, there it is. You want to see something pretty cool though? I love when I can do this. Hold on, don't go away. Price reached Fibonacci resistance. Nobody went short. Or nobody went long, right? Ugh, don't do it. Price came all the way down here. My triggers stayed above. Don't go short. Weak triggers into a fib. There's your reversal. Guys, I want you to see something amazing because when we talk about patterns that repeat themselves, that's just about the same look. The buyers push it up, they get a first smack of their heads on resistance, and then the sellers push, but the buyers are rarely done. Right near that mid-band area, they push all the way back up and the triggers are weak, and that starts the reversal. Exactly. That reversal gives the momentum. The area is not clear yet, but there's a mid-band. And guys, this is NASDAQ. It's a little bit different than crude oil or the S&P. But the patterns just repeat themselves over and over. And Vittorio, your screencast links aren't actual links. Could you try again on that? And let me know if you need help. Because I don't want to miss your pictures. But it's not actually giving me the link. What it's given me is just the number or the date, screencast.com. So when you have it, are you on Snagit or are you on Capture Software, Vittorio? Snagit, cool. So share it to Screencast, and that'll give you the link. You want to put get link. And if you have it default, like I have mine default, I'll just click that and it'll put the link right onto my clipboard. And then that's what the link should look like in the room. It'll give you that app.screencast.com with all those letters and numbers instead of just the date on the screencast. Let me know if you need any help with that. Look what that market did off the termination. I'm a believer. Feel free to sing it, guys. All right. So here's the second half. We're going to go and we're going to start looking at what you guys did. We're going to go look at your charts. Hopefully you've annotated them. You've talked to me about what you see, what you think, what you feel, why you did what you did. And I'm not going to give you feedback and say, man, you're the best, you're the worst, you stink. What I'm going to do is we're going to talk about advantages. So Grant, you got us going today, right? Look at that termination. Everything says up. Market is cruising. Small triggers break, large triggers don't. And this is really just a strong trend. And then as it begins to break resistance, resistance is not totally broken because look what it does. 1, 2, 3 divergences. And it pushes it down lower. Did you recognize that, Grant? Because I think this is an awesome read. Vittorio, perfect. Resistance, weak triggers, creates a deeper retracement, right? There's your deeper retracement. 3 divergences told you that it was possible. And then, Grant, I want you to high-five yourself and feel absolutely amazing about what you pulled off. You let those 3 divergences run their course, and then everything turns and agrees, and it pulls right back to support, right at those triggers up. Everything says the market's likely to continue, and you get out at resistance. This is outstanding patience. And Grant, I hope that you recognize everything that you did there because it really is. It's impressive. It's nice trading. 3 divergences can kill the trend or just create a deeper push, and that's exactly what it did. And then you had the mindset to just wait for everything to agree, to clear support, pull back, and giddy up. Nicely done. That's kind of next level trading already. And then here we do have that momentum, right? And we do have a clear path. And let me see if I can blow this up. 1 second. Are you with me, Grant? I just want to make sure that you are getting the feedback. Okay, cool. And this becomes one of the most common mistakes that I see. So I'm going to blow yours up, and then we're going to take a picture of your picture. So you had momentum up, and I think that your first entry was right here behind where you put place stop loss. But I want you to see something pretty outstanding here. Here's your reversal bar. And then Grant, that's your only area inside of favorable large triggers. And I know the market continued down from here. But instead of getting in at 84 and out at 70, do you see how you could have been in at 70 and out at maybe 63, 64? It turns that $280 loss into about a $120 loss. And that's rule number 3 working for you. Rather than jumping in, letting that market pull back, you see where it pulled back right to support inside of favorable large triggers. If you line that up with your large chart, there it is right there. That was your first entry. That was your best entry. And then as the triggers begin to return and the momentum begins to wane a little bit, relying on that great entry, that area inside of favorable large triggers is going to pay dividends. Does that make sense? It's a great chart read, great large chart read. Just a little bit off on the entry. Awesome. And the cool thing is I'm going to nag you every day of your life until those entries become second nature. What am I looking for, Paul? I've got weak triggers. I've got no areas inside of favorable large triggers. What Paul's talking about is when divergence with weak triggers prints. Grant, there's your momentum trade in reverse. Oh, Adriana, do you want me to look at your chart real quick before you go? Odds favorable. This is crude oil, right? 50-50. Perfect entry. Second higher divergence. Did it take you out? Do you see how it's a 50-50? And Adriana, these are the ones where I know you're in 4 contracts. This is where I'll take 3 off at $100 because the area is not broken. I'll go to break even, and it either goes or it doesn't because that area isn't broken. And if you'll notice, you don't have a good top up here. You don't have a termination that creates the reversal. It's not from no triggers through. So this 50-50 is even less likely to work. Does that make sense? These are the ones that you have to manage aggressively. These are the ones where you got to take that money, get to break even, and get paid. I hope you have an amazing weekend. Thank you for being here this week. Great job. Nice trading. And then back to this. Grant, do you recognize this look? Whoops. Guys, this is the momentum trade. This is the small triggers break the area, pull back to the 1-to-1s, mid-band Fibonacci resistance, and ride that mofo all the way down. Yeah, safe travels. What did you get me in Colombia? Because you know I love souvenirs. Just saying. One day we'll have a big get together. It'll be a lot of fun. We'll see what we can do. All right, guys, let's go to the next picture and see where we're at. Cindy says she's got a pina colada waiting for you. Come home. All right, Gary. Odds favorable. Everything says up. Pull back to support. Out at resistance. It is impossible to argue with that logic. Joel. Odds favorable. 50-50. Pull back all the way to resistance. Once again, it's difficult to argue with that logic, guys. And look at how the triggers are spread, right? Joel knows that it could go down here, so he has to make the decision on his stop. But the market just goes anyway with all that momentum with the pullback to support. Joel, I love that trade, man. Strong work. You too, Gary, if you're in here still. And then Gino got smoked. Not sure why, but weakish top. All right. Gino, are you with me, brother? Man, we should. All right. Gino, you know I have to do it, right? Let's talk about what's missing from your chart. Do I have? I love it. Every day is a good day in my world. I have a couple bad moments now and then, but it's always a good day. Do you have odds favorable momentum? No. Price reach a mid band. Large triggers full bar away. No clear path. All I'm doing is going through the rules. Gino, what color are your large triggers? Maybe you can't see it. What color are your small triggers? Are we talking about the short? Oh, shoot. I thought you went long up here. Hold on. My bad. This is where I respectfully apologize for missing your entry. All right, so this was cool. Let's just back it up. So you do have odds favorable momentum. I apologize, Gino. Some days I just need more coffee. You also have a clear path. So Gino, rockstar large chart. Not even a weakish top, because check it out. 1 divergence, 2 divergence, 3 divergence, and they're all cranking down. Gino, everything on your large chart said pick out the color of your next Ferrari. Would you agree? I agree 100%. I would. This is my favorite look. So let's go to the small chart and let's see if there's anything we can do to make life easier on you. So the first thing that I notice is that you take the perfect entry. And I want everybody in the room to see this. This is the perfect entry. That is right at the only form of resistance inside of favorable large triggers. And you are in at 2072.3-ish. So if you're stopped, and here's that real simple, right? And Gino, I know you're good at what you do. If your stop belongs 4 or 5 ticks above that entry, right, above that highest point of resistance inside of favorable large triggers, you could have been out of this trade, had you chosen to, at 07. You could have been out of this trade for 4 ticks instead of 14. Does that make sense, Gino? That's about the only thing that I think you could have done better on this trade. Because if it doesn't go from here, then I don't want it to go, right? If it doesn't go from here, that's it. That's the spot. That's the bounce point. Did it really? If it happens in a millisecond, there's just nothing you can do. Was there news? I don't think there was news at 9:45. Was there? Hold on. At 9:45, we had news, Chicago PMI. So you traded directly into news, Gino. That's why it got you so quick. So every morning when I say we know where news is so that we don't trade into an emotional response, you traded right into the emotional response. You went head first into a market that was about to react to the Chicago PMI. Well, that's a choice that you have to make. No, I'd never call anybody stupid. I might say you're a little misguided by ignoring it. Let me show you what, and you'll get a kick out of this. From right here to right here happened in 1 minute. That's the news reaction on the NASDAQ. That was from 59.50 up to 60. That was 100 points in the NASDAQ. This is what high impact news does to the market. You know what sucks is I was long 3 minutes before it and they stopped me out and then news printed and I couldn't get in until somewhere up here. So Gino, just, man, watch that news. And it's not even that, you know, slippage is a very real casualty of news. So we had it at 9:45, we had it at 10. You took the perfect trade, the absolute perfect trade, but you took it at the wrong time. You gave away your advantage of not getting caught up in a big emotional reaction. So great chart read, awesome entry, everything was beautiful. News got you. And then Vittorio, let's see if we can open your links. And visit site. Here we go. All right, Vittorio, in order to satisfy Rule 2, small triggers must cross above the divergence line. Or small triggers and large triggers must. So, great question, Vittorio. When the small triggers break the line, it has the potential to break with momentum, but the area is not considered broken until both the small and the large get above it. Great question. Does that make sense? And then Rob, strong triggers, headed up, wide and getting wider, waiting on a pullback. I agree 100%. Rob, you do have the wrong template on your 5-1. Are you with me, Rob? Let's get that fixed for you real quick. Because the small chart has to have synthetic and large triggers. In your defense, Gino, I'll tell you what, in my defense, every morning for the last 3 years, I've said that medium and high impact news can spoil your day. And I follow that with you get to make the choice on whether or not you decide to trade. So you were warned. You chose to ignore it. You got your butt kicked quick on that one. But you're right. Some days there may not be. And the thing is we never know who's waiting to react. There may be somebody that didn't trade last time it came out that's like, oh, I can't wait for that one. I'm gonna tear it up. And it happens sometimes. So Rob, if you're in here, I need you to load the 5-1 template on your crude oil chart. Because right now you don't have those synthetics. And they create an advantage for sure. Oh, and Gino, same picture. Was it supposed to be the same picture? Or Vittorio, sorry. Was it supposed to be the same picture? And did that get you cleared up? I'll just go to the pictures that I took today. And here you go, Vittorio. There's that picture. Whoops. Meant to give you both of them. You give other one. Okay. Did I click the wrong link or are those the same link? Those are the same link that you put in the room. If you want to post the second one again, I got you. And then Jeremy P. There's that S&P momentum short. You're absolutely right. And it's okay to hesitate. It wasn't perfect, Jeremy. Are you in here? So if divergence prints with weak triggers, not from an area, I'm expecting the mid-band. That's a pattern. So when everything rolls, this is just where you have to make a decision. Am I willing to take it from here? Or what I'll do sometimes, Jeremy, and I'm not telling you how to trade at all, is when you get the down bar that closes below that trouble, you've got your risk established already, right? You're not in at the best spot, but you're letting it go in the direction that you expect it to go. Does that make sense? And then you still capitalize. Cool. It's a great read, man, but it's hard. For sure. Are you ready, Gino? Let me show you. It's already built in. Hey Siri, set an alarm for 10:15 so I don't trade into news. Hey Siri. Set an alarm for 10:15 so I don't trade into news.
Your I don't trade the news alarm is set for 10:15 a.m.
How was that, Gino? Remember simplicity, man. I don't want to give you bells, whistles, dings, and chimes. Sometimes you got to be a little responsible for your own stuff. And that's what I do. I set an alarm or I put a big note on my computer monitor. But the alarm works better for me. All right, Vittorio. All day long, Gino. You're absolutely right. So once again, you'll have to decide, are you willing to trade? We had a high impact OPEC meetings once, and the entire classroom got their butts kicked all day long on it because the market was so erratic and emotional. So I get it. All right, Vittorio, this is such a good question. And you know what? Let's not do that. Let's do this. So the difference between favorable triggers and split triggers, and you're going to see this on both. Let me open up. I don't know why I keep closing my spreadsheet. Let me find the picture for it real quick. So the rules say, and guys, this is great. Rule number 3 says that we're going to buy an area inside of favorable large triggers, right? Which means that the tighter the triggers, the less room there is for areas. The wider the triggers, the more likely it could go to either place. So, Vittorio, your window of opportunity here where they're so close is perfect, right? That was the one right there. They're tight. It's easy. And here I have one-to-ones inside of triggers. I have a mid-band that's floating in the middle of nowhere. And then I have support down inside of synthetic triggers. So the window of opportunity is the cyan. It literally is. You don't know if it's going to bounce from up here or down here. And this is one of the reasons that favorable large triggers give such an advantage. When they look like this, your risk is easy to define. When it's like this, you're hoping that the top holds. Does that make sense, everybody? And then also, Vittorio, where the market's coming from has a lot to do with it too. So if I'm coming from the best termination condition ever, and I have the strongest triggers ever, and I don't have the gap theory back to my large triggers, and my smalls are outside of the large, the way they are here, I'm pretty stoked on taking it on the split triggers from the higher area. And then I'll just put my stop where the market shouldn't go based on that trigger line. But here where you have those weaker triggers and stuff like that into a mid band, I might be a little more cautious and respect that yellow one a little more. And that's one of those things that you'll get with patterns. That's one of those things that the more you do it, the easier it becomes to know when to make that decision. All right, Grant, down chart. Lots of termination. Heck yeah. Perfect termination condition. All the odds favorable momentum. And then you're in. Ooh, I like the momentum trade. All triggers below. There's the momentum trade. And then momentum goes away and you're out. Man. Hey, Grant, we found your trade, brother. When the large chart says giddy up, when the small chart says giddy up, Let the small triggers break the area. Pull back to it. You're in a little late, but that's okay. And zoom, zoom, zoom. Easy money. Grant, nice trade. Are you in here? Did he leave? That's beautiful. You're 2 for 2 on today. I don't know where your first one was. That may have been closed out on accident. And then Jeremy, that's the look for yours too, right? Termination, small triggers screaming over here, odds favorable here. Breakthrough, pull back. I love everything about this. You guys need to keep doing this because it sure does look good on you. Where am I? Dun, dun, dun. And then Lyle says the real good trade would have been to reverse at the exit of the long. No, it wouldn't, Lyle, sorry, because everything's set up. Let me see where your entry was. 10:02, 10:02. So we had a divergence, a higher divergence. Triggers rolling, still a little aggressive because you're coming right off that termination. Little aggressive. I might have at least waited for a reversal bar, something. Or close on the correct side. Just something to get me on the right side of things. Because look at how far back that pulled. Nice hold, though. And then Paul says first target hit, termination, odds favorable, 50-50 on the divergence low. He's taking the momentum. Right at the 1-to-1s. First target hit, and it got to the second line, Paul. Nicely done. There's that momentum trade again. Small triggers break, pulls back to the 1-to-1s when every chart's screaming down. That's crude oil. Really nice execution on that one. And then Vittorio, I think that I looked at this one already. That was the window of opportunity question. It sure was. And then Jeremy, termination, good top. Taking the Ron C. giddy up. Let's jump in and ride the wave of momentum. Nicely done. Didn't even wait for the pull. Well, you took the pull back to the small triggers. That's your plan. Small triggers at a mid-band. Off a termination. Small triggers didn't roll here yet, though. Maybe just a little. I like it, though. Nicely done. And then Rob. And Rob, that is the same picture. Yep, I got you. Smalls on the range chart rolled. Right on, Jeremy. Arnie Pie in the sky. Buh, 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 buh. Indeed, my friend. Welcome to the room. And then Rob, that's the same picture. Man, I do that all the time. Where I forget to clip the new one on there. And then did you go to your small chart and then right click? No, that's okay. So check it out. Right click on the small chart and go to templates down here and load. And for crude oil, you just want to get that 5-1 Renko bar chart on there. And that'll give you those synthetics. And don't worry, Rob, you're not alone on that one. Vittorio gave us a double post today as well. Everybody does it. It's a good top. Termination. No divergence. A lot of risk on that bad boy. A lot of risk on that bad boy, Paul. Gap theory on CL right now. And then Paul, this is a one. It is a good termination. But notice that your large aren't through and your large aren't through. Let's see if there was any information over here. And you're fighting those fat. I don't even worry about those. Do you see those triggers here? See how those small triggers turned against you and price got on the wrong side? This white bar coming up, closing on the wrong side of them. This says, Paul, dude, you got to wait. So that's a good pattern for you. Good pattern for you. Those are the ones that you'll get to the point to where you never lose them. And then Ron, beautiful. Weaker triggers, divergence prints, right up to the reversal bar marker. Absolutely beautiful. Not taking the 50-50 short, so Ron says, I figured out how to take it long. Very nice. Beautiful trade. Counter trend trade, white bar shouldn't work trade. I love it. And it flows off the tongue. All right, Rob, let's see what you got, bud. Perfect. Nice. You got it all squared away now. Good job, dude. Killing it with the pictures, too. Nicely done. Gets easier, doesn't it? So let's go do some chart reading. And this is the NASDAQ, and the NASDAQ's a different animal, but check it out. Weak triggers, strong triggers. Buy a pullback, right? Split triggers, and it makes it down to the synthetics, guys. That's why split triggers take away your advantage. That's a tough trade to enter. Weaker triggers, divergence on the 50-50. You guys know not to take the trade, right? Hits the mid band. Large triggers are a full bar away. There's the gap theory. Somebody pointed that out, JW. It closes the gap. And now everything's above support. The gap is closed. Momentum is there. Just don't really have a trade yet. Not one that's high probability. Some of you will find an opportunity. Weak triggers with divergence. No triggers and no areas inside. No reason to take the short trade. Thank goodness. Right? Rule number 1 not met. But rule number 2 is. Rule number 3 not met. Guys, I made this little slide chart. This is one of the favorite things that I've made. If rule number 1 isn't met, I don't have momentum, right? I did have a clear path, but I didn't have an entry area. Why would you ever give up more than 33% of your advantages, right? So if you went short hoping the market continued down, you forfeited 66% of what makes a trade amazing. And you just paid for it. Isn't it neat? That's right, I said neat. I might even say neato. Isn't it gosh golly neato? That 3 simple rules can get you into the absolute best scenario, and that 3 simple rules can keep you out of the worst. And now all you have to do is study them a little bit and get to the point to where you recognize them in a moment. Mid-band, my large triggers are all the way down to the reversal bar marker. It wouldn't surprise me to watch the market pull back down to there. Weak triggers at resistance. Oh my gosh. Is it this pattern again? Strong into the area, all the way back to the mid-band area. Triggers don't follow. Weak into resistance, small below the large. How many times have we seen this pattern today? Who's going long? Not me. It might work. That's not my money. And look what happened after the gap theory filled, guys. I love this stuff, but my lungs hurt. So what do you guys want to talk about? Roku, how we doing, man? Grant, how are you feeling? I know I got some of you that are at the tail end of your demo and you're in that decision-making process. Is there anything that I can help you with in that decision-making process? Is there any challenges that you're facing? Any questions that you've wanted to ask but you didn't? And we'll just leave crude oil up here. And you know what, guys? It doesn't have the commentary, but let me give you guys the slideshow that I work off of if you want it. Hopefully that proves to be a little helpful. And then Vittorio, when 13.2 chart crosses above midband, small triggers cross above midband, can I go long on the 5-1 chart, or do I need to wait for the large chart crossing above midband? Vittorio, great question. So let's go to termination conditions, straight from the user guide. And let's do that one cool lesson. You ready? So the large chart midband, we're going to do it right now, guys. Great question. The large chart midband will behave as a termination condition if the large triggers are a full bar away. So this is the gap theory, Mario. Dwight, this doesn't mean a potential reverse in price. I mean, potential, yes, right? It's never guaranteed to happen. But here's the deal. Here's the deal. Trading is not a crapshoot. These patterns repeat themselves all the time. The gap theory repeats itself all the time. So check it out. Vittorio says, can I go long? Well, this is the gap theory 100%, ladies and gentlemen. If price accelerates away from the large triggers and hits the midband, Vittorio and everyone else, excuse me, this gold marker right there at 78.32, that is the point at which this bar becomes a reversal bar. This is called your reversal bar marker. So Mario, if your large triggers are below that reversal bar marker, the midband is a termination condition. So Vittorio, by the time the small triggers get above it, what you're really looking for into a midband is that these large triggers get above the reversal bar marker. And then if we go back and you look at what the live market did, look how it closed the gap. Mario, do you see it as well? And what you guys will see, price reaches resistance, the large triggers were a full bar away, and it closed the gap. You're welcome. Let's see if we can find other examples. Price reached support and a midband, the large triggers were a full bar away, and it closed the gap. And there's that pattern again, right? Termination, push to support, weak triggers, there's the reversal. So this is one of those things, guys, where I like to study it a lot. I like to look at these patterns that repeat themselves. All the way into resistance, large triggers don't follow, and it closes the gap. Into support, closes the gap. So what this does for me is it keeps me from taking that long right in the middle, Vittorio, Mario. It doesn't tell me go short to try to close the gap, because that fights momentum, that fights direction. And guys, that's just not a high probability trade. Ron's found a way to capitalize. So this says I'm likely to pull to here. But now I've got odds favorable momentum. Now I've got a clear path. And does everybody see how there is one line inside of triggers? There is one line where that market is most likely to continue based on rule number 3. What do you guys think? Are you willing to risk your money on this look? I won't tell you when to trade. I won't tell you how to trade. I won't tell you when to get in, when to get out. I won't even tell you how to manage your trades. So closing the gap, Dwight, when price is up here and the large triggers are down here, that's the gap. And what happens is this acts like a vacuum, man. It's like a Hoover. And it just, more often than not, where's that picture? More often than not, it just sucks price back down to it. And it does it enough that it's a pattern that we say, this is a pattern that is repeatable. This is a pattern that can be studied. This is a pattern that more often than not, it does in fact close that gap. So what this does is it keeps you guys from trying to go long at that midband. Does that make sense? Or if you're Ron, divergence, he'll try to ride it back down. But Ron's got a little more experience. The fact that this is a bad bottom, that this didn't come from an area, takes a little bit of the giddy up out of this long, because the sellers came from a termination and they tried to push through and the buyers fought back. The rules are met for a trade, guys. This is a chart read. When this is a bad bottom, Notice how the only place where the market is likely to continue is right here. If I get filled, guys, that's my stop. I'll risk 6 ticks on it. It's okay. Let me open up Vittorio's picture again, Rob. It's a pretty cool concept. And all it is it lets you know, wow, when the midband is likely to hold, when the midband is likely to be a termination condition. This gold bar is just where this becomes a down bar. Does that make sense? I think that's the first part of it, is understanding that this gold bar is just where that becomes a down bar. And if your large triggers are below it and price reaches an area, it's likely to come back to those triggers. It's really, that's all it is. It doesn't say go long. It doesn't say go short. All it is this is how we identify the midband as a termination condition. And if you go back and study it, look at that. It hit our order, but it didn't fill us. Those sons of guns. If you go back and look a little bit, Rob, you'll notice a lot where these gaps happen. And you'll actually get to the point.
Order filled.
Oh, all right, there's our order. If it's going to go, because that's a bad bottom, I'm not going to give it a lot. I'm going to say it either goes from the area inside of triggers or it doesn't. I'm willing to take a small loss on this trade, but because of the bad bottom, I'm really not willing to leave a lot on it. But this gap theory, everything above support, suggests that this may be a pretty good trade, but 1 divergence, 2 divergence. We just got to wait and see. Does this make sense to everybody? I'll risk 120 bucks on this look, but because of the bad bottom, I'm not going to put my stop way down here. I'm not leaving $500 on that trade. I'm going to hope for a reversal bar, and hopefully it gets to 61. That's $100. And then 71 represents $200. And this is a look that typically wins more than it loses. And there we go. That's it. It may still go up, but I'm not going to lose a lot of money on this one. All right, let's see. Hold on. You like the risk management discussion? It makes sense, doesn't it, Paul? And then Dwight, large triggers should be close to the midband. Not to represent strong triggers. Dwight, the only thing it is, and I may have run that a little tight, but that's okay. We're just talking here. The only thing it is if the large triggers are a full bar away when price reaches the midband is a termination condition. That's all it is. That's all it means. Right? It has nothing to do with strength. Strength is represented through the triggers. But if you reach a midband and the large triggers are a full bar away, it's just not, it's a termination. It's rule number 2 not met. Does that make sense? If they're just above, Collie, so if they're straddling it, maybe, then technically it's not technically the midband is not a termination condition, right? Keep it real black and white in the beginning. Look at that. I kept it inside the synthetics. It may go. That's okay. Because what you'll find a lot, and let me see if I can open up here. Boom, boom, boom. I want to find, I saw one earlier when we were looking. So these large triggers weren't a full bar away, right? The reversal bar got a little inside of them. but it's still coming from a termination condition. So even though the gap theory wasn't officially in place, you're still not going long, right? And then even though they weren't quite a full bar away, you're still into a termination condition. You're still not going short. So if it's close, Collie, and I have to make a decision between two areas, right? If it's close and I have to make a decision between a mid-band here or one-to-ones here, I'm probably looking for the lower area. I'm probably looking for the pullback to try and get closer to those synthetics rather than the large trigger kind of floating in the middle. See that? I'm shooting for this fib instead of this mid-band. Does that make sense? Great question. And then Tie Man, you have a 60 fib? So this is where I ask, Tie Man, how many days back are you on your charts? If we don't line up, guys, I always ask the questions. You guys have it? 10? Did you clear out your database cache this morning, cache tick? Ron, you have it too on 7? Every day? Eastern time frame, Ty? Yes? Ron has it on 7. Are you running the newest version of the software, Ty? I'm just going through it. Everything I can think to ask. Yeah, it might be me. Because I did crash and then I reloaded. We'll see if it recalculates and gives it to me. And it may just be a little tick discrepancy. And that happens sometimes. Two divergences. Just pushed it lower. That's okay. I'm willing to lose that one. And then I would have found, on the reversal bar, I probably would have re-entered. Let me try one more thing. I'll do an F5 on this chart and let it rerun. Sometimes that happens, Ty. My brother and I sometimes don't line up and we can't figure out why. Oh, here's one. What data user are you with? I'm on Tradeovate. Because we did see discrepancies between my brother and I when he was on that CQG and I was on Tradeovate. And I don't know why that is. So that may be it. Is there may be a one tick difference between yours and mine that creates discrepancy in swings, that creates discrepancies in areas. Ron, what data are you using? You're probably CQG as well, right? Continuum? Yep. And then you guys, who's on Tradeovate? Can somebody with Tradeovate show me a crude oil chart? Paul, do you have a 60 fib? He may have already gone. He's probably running the kids to school. And it's weird that that would happen. It's still the right trade. I managed it probably way too tight. You're only 9 days back. So it happens. And then there we go, guys. You didn't have any. It did pull back to the synthetics. There's gap theory filled again. Isn't that kind of cool, though? All the way up here, we said I wouldn't be surprised if it pulled back to here, and it did. So, Mario, there's your gap theory again, man. It doesn't mean there's a long trade. It just means don't get in at the mid-band. Termination for the win. So, guys, I'm going to take 5 minutes again. I'm going to go high-five my wife. She actually took the day off today. Cool. And Mario, just scroll back. Like we saw it on crude. There it is on the S&P. And guys, this is a great way to study. You have historical data. Check it out, Mario. There it is again. Boom, boom, boom. There it is again. Not quite. Look at that mess there. There's a great example of it. So you have 10 days worth of data, guys. Go back and take a picture of 10 gap theories. Like, let that be your homework tonight. I'm going to go take a picture of 10 gap theories, and I'm going to remind myself that that creates a problem. That creates a challenge, and I'm not going to trade into the gap theory. So, guys, I'll be back in 5 minutes. If you have questions, post them. If you have charts, post them. I'm going to open up my PDF again after this, and we're going to look at a couple management ideas. So we'll talk management last hour. I will tell her hello, Ron, and I'll see you guys in just a minute. Well, hello, beautiful ladies. All right, guys, back at it last hour. Check it out. They didn't make their target, went to the mid-band, gap theory, went to the same up again, pushing against. There's a textbook termination condition, whoops, at a divergence low. So just sitting tight. It's hard to do, isn't it? It's hard to sit tight. It's hard to do nothing. It's hard to feel like you're not making money when you really want to be making money. But the reality is it's just not all yours. Walk in, demand all the money. You're a bank robber. Walk in, ask for your money. You're just a customer. So let's be customers. And I'm going to do some management talking, guys. We talked about being 2 ticks below, right? We talked about being 2 ticks below the reversal bar. This gives you the opportunity. Understanding where the market shouldn't go, it gives you the opportunity to minimize losses, guys. So if you're long and it gives you the reversal bar and you move it and that's your rule, then guys, stick to your rule. Take that small loss. You can always get back in if it's a better trade, if it's a better situation, but that's the right way to do it. And having that mindset that management isn't an option, that moving stops because you're scared isn't an option, is going to pay dividends. Another thing and another way you can manage these trades, guys, is using those divergences. I got this one from my brother, and I like it a lot. A second lower divergence. We know that 3 divergences and the final one's lower is problematic. Guys, if you're in a long trade and you're in and it goes up, and this is where quick profits pay dividends, a second lower divergence is likely to push it lower, to probably take you out, especially if you're break even. So if you see that divergence print here at the 3rd bar, you have the opportunity to just get out, right? And if it doesn't give you another opportunity to get in, well, then you avoid all that downslide. The negative number, I'm sorry, somebody asked this and I didn't answer it. Who asked about the negative number? And I apologize. I saw it and then I got distracted. Now I have to find out who it was so I can apologize. Scrolling up. It was Jay Roth. I apologize. Okay, Jay, are you still in here? Oh, he's not. Dagnabbit. I'm going to have to send him an apology. So, guys, I never miss your questions on purpose. I promise that I never miss your questions on purpose. But sometimes I just miss them. And I apologize if I ever do that to anybody. It's okay to repeat your question. It's always okay to repeat your question. So the negative number is a byproduct of creating divergence. The negative number is just the market telling you that divergence is true. And then once divergence is true, it means that there was a loss of momentum. And that's really all it is negative number print, cyan comes off to the right, divergence is true. And it means that there's a loss of momentum. So were you going to use this as a management tool? Sorry, I'm trying to multitask right now. And the management tool is if I go long and a second divergence prints and it's lower, I can get out. If I get a new signal up in the direction of the trade, I can get back in and take that trade. I can do whatever I want. But the idea that the second divergence can ruin the party, we see it here. Second divergence ruins the party. Second divergence has the potential to ruin the party, but that reversal bar says, no, let's go with all that momentum and that clear path. And then if you don't get that next signal, well, then it keeps you out of that next loser, guys. So that's one of the things that you can focus on management is utilizing that second divergence, giving you the opportunity to not get caught up in those trades that that don't have the higher potential to make it. It just becomes a great management tool. Where am I in my... All right, next management. You ready? If you're trading, you're in the trade, you get up, you take your long signal, everything's good, and you reach yellow one-to-ones. Guys, that's a great spot to get paid. These yellow one-to-ones are a definite psychology point. And understanding that they can create bounces, understanding that they can create challenges, it's just a great place to take part of your profits. If you're taking 2 contracts and the yellow one-to-ones are at $90 instead of $100, it's okay to take $90. And then if divergence is true off of the yellow one-to-ones, man, that's where you sit tight. Divergence off of one-to-ones can be a deal breaker. Divergence is true after 2 down bars. If there's a new signal, you can re-enter along. And since there wasn't, it keeps you out of that and it keeps the profits safe. And guys, all of these are on that PDF that I gave you. All of these are on that PDF. If you're short and the market reaches Fibonacci support, get paid. How easy is that? And then once it holds, don't go short again. And then if you're long and you reach a divergence high, once again, the same way as the one-to-ones, guys, it's a great place to take part of your profits. It doesn't mean that you have to exit the trade, but get paid on half of it. And then once you get paid on half of it, if the market pulls back, get back in, right? Make that money again. Is anybody listening? Maybe they are. I don't know. We're good. And guys, that's it. Those are the managements. Just making sure. Sometimes I just get on a tangent and I'm like, I wonder if I'm muted. So I am darn near out of smart stuff. And that's okay. And there's obviously not any trades going on right now. So let's cover this one. And guys, this is straight from the education materials. This is straight from, straight off of, where's it at? I'm going to show you. Haji, you posted? Of course you did. That's where we need the timers. Right on, Grant. I hope it's a good call. And man, I sure hope to see more of you. I hope it's in your plan to stick around and learn the software because you're doing great with it. So have a great afternoon. When the Germans bomb Pearl Harbor, let Ron go. He's on a roll. All right, Haji. One so-so, one bad. Good bottom. Not quite a good bottom, but pretty close, right? And then the first one, the gap theory gotcha. And the second one, the gap theory gotcha. Huge stop. So, Haji, were you listening on the gap theory? Did you catch that? I'm telling you guys, the gap theory is a killer. The gap theory will get you every time. You wrote it down for homework. So, man, just go back and scroll on a couple charts, and you'll begin to see it more and more, Haji. And here, I've got some pretty good pictures of it too. So let me grab a couple. This is my favorite. This is the one that just says kind of what's happening. It reminds you that it's like a slingshot. And I think that one of the coolest things about what we do, and Haji, I hope you appreciate this. If you don't, I'll find a way to survive. Is that it doesn't say anything other than don't go long here yet because of the gap theory. But the cool thing is it saves you 3 points 6 times over or 4 times over. And then on the second entry, it saves you, another, what is that? 1.5, another 3.5. And it's pretty awesome because once you recognize the pattern with some regularity, once you recognize the pattern consistently, is this is, oh, I don't know, we'll just call it $700 that you don't have to part with, right? That's $700 that you don't have to give up because you don't trade against the gap theory anymore. And that's one of the great things about just all of the rules reminding you. So here's a good picture with a good description for you guys. When price accelerates away from the large triggers, hits an area, it could be fibs, mid bands, whatever, you have a gap. Price often closes the gap. It acts like a vacuum. So seeing your large triggers below the reversal bar marker creates a great opportunity for you to just kind of stay out of that trade. The same thing is here too. You see the divergence, you see the momentum, and you want to go short, but the gap theory is just like, all right, let's pump the brakes and sit tight for just a minute. And then I think I might have another gap theory in here. Maybe not. That's not it. Nope. There we go. So there's your gap theories. Good stuff, Haji. Thank you for posting that. And as usual, I don't know how you sneak in pictures when I'm on a rant, but you tend to. All right. So I wanted to share this with you guys, and this is from, so you are stealthy. You're like a ninja. And I'm going to drop this in the room too, just in case you don't want to go to the link. But this is from the page. And this is kind of the idea of the psychology of trading. So I'm just going to read it out loud, guys. You don't have to watch. Watch the market. Take trades if you have trades. But learning it to trade at a high level goes beyond simply making money. It involves understanding which next-gen indicator patterns can be executed confidently, which comes through trading both winning and losing trades. Embrace the learning process and don't fear losses. As long as you share your trade outcomes in class to promote growth and prevent repeating mistakes. Keep your focus on consistency and achieving successful results through your efforts. Nexgen emphasizes that new traders should complete their education using the simulator and market replay. Again, we do not tell you how to trade. Many traders make the mistake of testing their trade rules and emotional control skills too early with real money. Without a winning mindset, trading with an incomplete or poorly developed plan often leads to avoidable losses and frustration. Once again, why I hand out the KISS plan every day you guys are in here. Nexgen provides all the necessary tools to avoid these pitfalls. Everyone can win, but thinking and acting like a winner requires a conscious choice. Nexgen's technical patterns provide a statistical advantage, and your mindset and execution of those advantages will determine your success. John Novak, CEO and developer of Nexgen Fibonacci software, had valuable discussions with the trading coach, Mark Douglas. Guys, if you look on YouTube and look up Mark Douglas, you'll be absolutely floored by this gentleman. I would suggest that you move him to like 2 times speed because he is the king of dramatic pauses. But Mark Douglas focused on the psychology of traders in the early 2000s. Unfortunately, he's no longer with us. The time spent with Mark Douglas influenced Nexgen study ideas. To understand Mark Douglas's methods comprehensively, read his book, Trading in the Zone. It's an awesome book. I've read it. Mark Douglas suggested tracking the performance of your trading rules based on a sample size of 20 to 25 trades. By focusing on high probability trend trades after a strong Fibonacci-based top or bottom, you can master Nexgen's trading concepts with each sample size of trades. Active participation in class and educator feedback will help you avoid mistakes and enhance your learning. John Novak believes that a deep understanding of your technical analysis advantages and constantly executing the correct trades will positively influence your trading psychology. If you ever find yourself trading with fear, anger, frustration, or seeking revenge, that's mine. It is crucial to stop trading and refocus on the highest probability trades in your management rules. There is no shame in returning to the simulator. Rebuild confidence in your trading plan when necessary. So guys, I wanted to give you that one. That has been on this website for as long as I can remember. But it's so true. The psychology is the second half, guys, which is why it's so important that we have these rules met trade, which is why we have these advantages. And when you stop worrying about wins and losses and you focus more on the execution, you focus more on getting in at the correct spot. You focus more on managing it the way your management plan says to. Well, then what you find is that when the market is in this nonsense state where I don't have momentum or direction, I can't find a clear path, it's easier for you to accept that you simply don't have a trade and that it's okay to sit on your hands and do nothing. Dun, 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 dun. So we talked about management, we talked about rules. I gave you a plan. I gave you the PDF with every picture that I used to teach this class. What else can I give you? What else can I give you? How about, since we just talked about psychology, I'm going to give you guys a PDF, Emotion-Free Trading. If you find yourself a little aggressive now and then, a little fearful now and then, Emotion-Free Trading is a pretty good read. I think I've read it 3 times now, and I always get something else out of it. It's like anything. It's like watching a video over. You get more out of it. So that's a good read. Termination, they're trying to reverse everything, aren't they? They just haven't yet. Weak triggers at a termination. How many times have we seen that create a big push down? So we just kind of have to wait and see what happens. Going through the arsenal at this point, guys. Here's another one, 7 Habits of Highly Successful Traders. Outstanding read. Do I have any newer folks in the room? Anybody wondering what they got themselves into here? Roku, you're still relatively new, right? Arturo, Grant, I think you're on the phone. This is kind of a fun look at exactly what you guys are in for. Hey, you joined today, Arnie? Nice to have you in here, man. I'm Mark. I run the show here. Kind of. Actually, you guys run the show. This is your classroom. Everything revolves around what you want to talk about, but we talk about patterns. So Arnie, welcome, and I want you to be excited about participating. I want you to be excited about posting everything and asking everything, and don't hold back, man. I want to get you every answer that you need. So day 1, it looks like fun, guys, and it's like drinking from a fire hose. Yeah, and it does. And you know what? This is going to pay better than college if you learn to do it right. Everything looks like fun in the beginning, but I fully understand it's a lot of information. It's a lot coming at you. And that's one of the reasons that we try to keep it so simple. And then you're like, holy shit, this is hard. This is about day 2. And you newer guys, back me on this. Around day 2, you're like, this is overwhelming. This is so much stuff. I'm never going to be able to do it. And it feels like that right there, right? It feels like, where's my favorite one? This dude right here. That's the Nexgen user on day 2. And then you're like, I'm not sure, but I keep seeing it work. I want to be a part of this. And then you think you've got it and you're a master. You follow that checklist. You're like, I'm the best trader ever. And that's when you go live too soon. And this box right here, Cindy, this box, we've all been there. So guys, when I went live the first time, that was exactly what I lost. And I lost it in 1 day. 1 day. Really in about 22 trades, to believe it or not. And I'm gonna expand on this real quick though. When I started learning the software, my brother told me to post my trades in the classroom, and he said, use the spreadsheet. He said, Mark, all you have to do is go take 20 pictures of the perfect long trade. Go take 20 pictures of the perfect short trade, commit it to memory, try to take the trades, and then post in the room and I'll give you feedback on everything that you do. Well, of course, he's my brother, and I said, whatever, I'll do it my way. And I didn't have a plan, and I didn't take a picture, and I didn't participate, and I had no idea what I was doing, guys. And I got exactly what I had set myself up for. My results were indicative of my efforts to learn it. And then we get to this I don't know shit. That's where Cindy is. Because Cindy thought she had it, and then it turns out that maybe you didn't take pictures and study pictures. Maybe you didn't write a plan out. Maybe you didn't participate as much as you wanted to. Maybe you only showed winners and didn't show the losers, where we could really dive into and make sure that you don't repeat those mistakes. That's okay. I'm not saying that's what you did, but that's typically what people do. And right here is where you guys have to make a decision. Right here is where you have to decide whether or not you want to follow the path that now, I like that you put now after that. You either follow the path that's been proven. Nexgen has been teaching people for 27 years. For 27 years, they've been teaching people to trade the markets, to read these indicators. I've been doing it for the last 3. And if you just take a step back and you allow it to be simple, if you focus on 3 advantages, it begins to make sense. And then you get a little surprised. And then you're like, oh my gosh, there I am. Look at me go. And guys, this is pretty normal for everybody. And David H., you joined Monday. Welcome, man. I love it. And you're in the or not phase, Haji. Yeah. And Dwight, you say your way is horrible. Guys, nobody's way is horrible. Your way is your way, and you're going to do your best because, guys, we're all egomaniacs. I don't care if you're a guy or a girl. I don't care if you're college educated or not college educated. Cindy, what went wrong with this one? What do you think went wrong? Definitely weak triggers at a termination condition. 65 years old? Pff, young. And that termination didn't work out for you, did it? So Cindy, when you wake up tomorrow and it's time to trade, I want you to look at this picture. And I want you to go, man, that termination kicked my ass. I'm not going to trade into those anymore. I'm going to let them break. Or if I'm going to take that trade, I'm going to do it with strong triggers, right? And that's all you can do is take another step forward every day. And then Lyle, interesting day in oil. Large trends have had great momentum, but small chart has not had follow through short term. It's taken correct entries to make it work today. Wow. So Lyle, you're saying the rules work? Did I hear that right? Great entries create manageable trades, right? I've said that once or twice. And sometimes the market doesn't follow through. We can't control that. Great entries make it easier, though. They really do. 63. Guys, you're just not old. I hope you realize that. All right. CK, nice to see you back, brother. I see an exit down here. Trying to figure out where you went short. I see an exit there. Down to termination. That's awesome, Bob. Up 3,800 today, Lyle. That's it? Slacker. And Lyle, you've only been with me for what, 2 or 3 months? I know you have a lot of experience. You haven't been with us that long. All right. Started in January. Yeah, that's 2.5 months. That's not so bad. Got both those guys by a couple, Ron. I like it. All right, CK, are you with me? Will you do me a favor? And this will help a lot, if you don't mind. Right click on your small chart. And if you go to data series, scroll all the way to the bottom and where it says plot executions, let it be text and marker. And what that'll do for me, and this is me being selfish, is it'll show me on that small chart right where you entered, and it'll show me right where you exited. So here I'm looking at it, and I see an exit down here, and I'm looking for the pink arrow of where you sold, and I see an arrow right there, but I'm having trouble figuring out where you're getting in and where you're getting out. And then the other side of that is, if you don't mind, let me see your large chart. Let's see, because the range charts are cool, but they don't lead the way. The range chart is nothing more than a confirmation chart in most cases. So I'd love to see the large chart. I'd love to see what was going on. And unfortunately, and man, I hate it when I have to say this, I can't give you really much feedback here because I'm not sure what's going on a higher time frame. If you want to minimize this bad boy and show me the two, we'll at least do the chart read together, and that's crude oil. I guess that was yesterday afternoon, towards the end of the day. 343. You'll be 63 next month. I'm 52 this year. And I'll tell you what, I feel like I'm just now hitting my stride. 33, Cindy. Bracita. Muy joven. I really, 40s were great, Jeremy. 34. You look 24. Over 21 next Tuesday. I like that. Over 21. I did too until my mid 30s, Jeremy. So there was the termination for the win. Created the reversal, gave the momentum, no divergence, pull back to the areas, and it went, right? Pull back to resistance, and it went. Yeah, I imagine. I'm glad I didn't know in my youth what I know now, because I would have taken over the world. I totally could have. Next Tuesday. So guys, what do we think? Termination, reversal, odds favorable. Should we take a NASDAQ short if it gives it to us?
Order submitted.
Pull back to resistance right inside of those triggers. It may not get there. It didn't get there, did it? Darn it all. Oh, are they coming back for me? Oh no, termination on the small chart. Youth is wasted on the young. Amen. And Steve, you just got out. You caught the shorts and took it down to 66. Beautiful trading, Steve. Nice job. You know what, Bob? Mentally, I probably feel like, I would say 18, but I'm going to say like 30 because I was a little smarter then. Physically, I'm about 173. The Novaks have notoriously bad genetics. Steve, beautiful trading, man. I'm glad you caught that. Not surprised at all that you did. All that momentum, guys, momentum for the win. The momentum goes away, it becomes more difficult to trade. I think that's the most important thing that we can talk about all day long, is that momentum pushes the market. And when everything is wonky, the market doesn't push. And when a termination is reached with weak triggers, it creates a big honk and bounce like that, right? And then Jeremy P just went long at 75.57. The warranty runs out. Yeah. 75.50, Jeremy. Is he out of the room? He's out of the room. Oh, didn't work, huh? Didn't go long? Good. Let those things roll a little bit. Makes it easier. Nice job. That looked a lot like your trade, though. I wasn't sure if you were going to take it or not. My brother used to say, are you going to trust a little pink line floating in the middle of nowhere? Not on NASDAQ. Oh, okay, you're not in the NASDAQ. My crude chart's not open. Let me find a crude chart. Guys, is there a topic that you'd like to discuss? Is there something that you're curious about? Is there anything I can help you with? So Arnie and David H, excuse me. Are you guys comfortable taking pictures yet? Everything, all the feedback in this classroom is dependent on your ability to share a picture. Here's a great tutorial on making it happen. You know what? I want a picture of you, and then I want a picture of your charts. I love seeing pictures of you guys. Haji, the only thing that some traders have to adjust on the Apex, and that's a great question, and let me tell you what happens. Before the Apex evaluation, Haji, this was your long trade, right? When you're trying to qualify, That's your long trade. And then that's your long trade. And guys, back me up if you've been there. And then once you qualify and you start thinking about the money, that's your long trade. And once you start qualifying and thinking about the money, that's your long trade. The average trader is going to break their rules to get paid once they get on the evaluation. So most people on the evaluation, they're really following those rules and they want to evaluate. So I don't trade any differently. Haji, my goal is to get paid, right? And Apex's goal is for you to get paid so that they can get paid. So let me show you. If I go long right here, if I'm on Apex, that's it. That's my target. When I'm on Apex, I don't hope areas break. I exited areas. That's the biggest thing. And even more so, when I get this close to an area, I tighten my stop up. Because Apex, if you go up $1,000 and it retraces 800, you still made $200. But their trailing threshold is calculated off the $1,000 that you were up. So for Apex, I think one of the smartest things you can do is get paid. Don't suffer retracements. Utilize those key Fibonacci areas. Make sure that you're trading with momentum so that it's more likely to get there. All the things you should do anyway. Everything we talk about anyway, right? And that's just crude oil grinding up. And then Debbie, you asked for a little movement, so I pushed it all the way down to that termination condition for you. You're welcome. You owe me one. So Haji, if I were an Apex trader, no matter how strong the triggers are, that's my exit. That's probably, I told my brother I should teach a class on getting paid in Apex. Take the right entry so you can have the least amount of risk, get paid at the key areas. Because from 88 to 04 is a lot of money. And this may break. Well, Apex drawdowns aren't a killer. They start at 2 a.m., Rob, in the European. Cindy, hope is a killer, right? Cindy, hope is a killer. I hope this area breaks, but instead, I get stopped out up here. That's what makes the drawdown kill you. And Jeremy, you're absolutely right. Don't over leverage yourself, guys. If you're on a $50,000 account, in most cases, there's no reason to be trading more than a 2-lot ever. And think about it. If you can't make 50,000, I would say, if you can't make $500 a day on a 2-lot, then it's not anything other than your execution, I promise you. $500 a day is such a low end on a 2-lot. That's $250 a contract. My brother's goal a day is $1,000 a contract. $250 a contract, guys. If you pull that off on a 2-lot every day for a year, every trading day for a year, it's $126,000 a year. If you double it with the exact same management plan, it's $250,000 a year, guys. You don't have to make all the money. Just make your money. Make the best money. Make the easiest money. And if all your triggers are going down, don't go up. And if your momentum is to the downside, don't go up. It doesn't have to be difficult, does it? It doesn't have to be challenging. It doesn't have to be complicated. It doesn't have to be anything more. Jeremy, when I hit my goals, I go to a 1-lot and trade until I lose. It usually takes me 3 trades to hit my goal. So I'm usually over my goal, and a 1 lot loss keeps me above it. So that's what I do, but everybody's different, right? So Haji, I hope that was helpful. Cindy, get paid. Get paid. You're good at this. I've seen your chart reads. You're great at it. Take a deep breath, make sure the rules are met, get paid. It can be that easy. I don't have the best momentum, but I do have a clear path. Right? Does everybody see this? That's a huge push, right? They're getting tired. How do I know they're getting tired? Divergence just print. I don't have any areas inside of triggers, so I don't know where it's going to bounce. Is it going to go to 35? Is it going to go to 44? Is it going to go to 51? Hell, I don't know. Or is it just going to go down? If it does, it's not my trade. And I just talk to myself in terms of advantages. Every time I look at a chart, guys, what are my advantages? I have weak triggers, the large haven't broken, divergence printed. I'm just not taking the long. No matter how much this market grinds up, it just might not be my money today. The S&P is falling out of bed and not giving really any opportunities. And that happens sometimes. And one of the most common questions I get is, so Mark, how do I enter if it doesn't give a pullback? Mark, how do I enter? Well, I guess you don't. Not as a brand new user. As an experienced user, Ron goes short somewhere over here and gets paid right there before the next line. He's pretty good at that, though. He's got a little experience reading charts. So what do you want to talk about, guys? Wow, look at that. I guess it wasn't going to pull back at all. You went short after the candle turned white on the chart on the left. The chart on the right showed prices below with scissors. The large chart behind left chart turned red. Understanding it's against trend rules. That's okay. And CK, let me tell you, man, I never count off if you make a mistake. So let me open up your chart and look at it. And that's just what was hard. It was just that's the only thing for me is it's just a little difficult to read. So you had a termination probably up here. You took a white bar below the fast triggers and took it down to support. Is that pretty much it? Right about here you got in when you cleared the area, took it off at support? Freaking brilliant, CK. Is it CK? I left the 42 off, but brilliant. And that's great usage of this chart. The patience to wait for the white bar to clear the area. I see it now. I love that trade. All right, so lose on your real accounts and now on Sim you won. So where did you get in? You got in at 34. You got in on a momentum style trade when the smalls broke, pulled back, went down, and you made easy money. CK is fine? Okay, cool. And then, hold on, Cindy. Live, you traded into a termination condition and hoped that it would break without momentum and got your butt kicked. Sound about right? So when there's money involved, you skip the process because you're focused on the money. Quieres dinero. But when it doesn't matter, you follow the rules beautifully and get paid. Because now you're not thinking about the money anymore because you know it's monopoly money. But, oh, bless you. Salud. But do you see why? Isn't that crazy? When money's involved, we forget the process. When money's not involved, you take the perfect momentum trade. And guys, this is so common. And Haji, this goes back to what we talked about, right? When money is involved, that's our long. That's our long. That's our long. When money's involved. When there's absolutely no money involved, it's easy, right? That's a bad bottom. Directly into the midband. The large triggers were not a full bar away. If you took this entry, it pushed you right back. So Cindy, and it goes back to trust again, right? Did you play sports? Volleyball. Okay. We've probably done this before, right? But to be good at volleyball, you can't just want to be good at volleyball, right? You don't win the game because you want to win the game. You win the game because you learned how to serve. You learned because you learned how to set. You learned because you learned how to spike, right? You had to learn the process, and then when collectively your team was great at the process, the victories followed. Would you agree? So that's all you're doing, Cindy, is you're learning to trust the process. You're learning to trust the idea that momentum is an advantage that you don't want to live without. You're learning to trust the idea that a clear path is an advantage that you don't want to live without. And guys, the desires don't create results. Process yields results. And then CK, it was paper trading, would likely get your behind kicked if you tried that with real money. I don't think you would, CK. That wasn't for you, brother. Let's talk about why. Because your large chart had come off a termination condition. Your small chart, so your large chart had a 50-50 and the large triggers were already down. I know this because the synthetics are red. So you're coming off of an area. And instead of going long on the 50-50, what you did is you took the momentum that was confirmed on this chart from there. I love this trade. It's just Ron C. invented this trade. That's a pattern that's repeatable. That's a pattern that you can verify over and over. Notice how your large chart, large triggers never turn green. Notice how they always stayed red. That large chart was telling you that whatever's going on up here, dude, it's done. That's it, not happening. And then this white bar just kind of confirms, yep, we're going down. And you get to the right side of those triggers. I love this trade, man. But Cindy, embrace the process. You got this. But here's the deal, guys. If you're struggling live, and then simulated you're a millionaire, it has a lot to do with really focusing on the money. And I know because I've blown out accounts where I have done great on simulator and then I get lost. It adds a level of pay attention. All right, so story time, and then we're going to finish it off. So I used to road race motorcycles. I used to endurance race 600s. And I was out of practice one day. Sorry, new guys, you have to hear the story. You old guys have. And it's practice. And you race motorcycles? Hell yeah. And I'm out there and I'm just having fun. I'm like dragging an E through the turns and doing wheelies and having a good time. And a buddy of mine passes me. I'm going maybe 60%, 70%. I'm not going fast by racing standards. And he passes me and he looks over his shoulder and he gives me a big WTF look. Like, dude, what are you doing? And we get back to the pits after the practice is over and he comes to my pits and I wasn't ready for this. And he goes, Mark, what the F are you doing out there? Why are you going so slow? And I'm like, dude, Bradley, it's just practice, man. And he said one of the most profound things to me. If you don't practice like you want to perform, how can you expect to do what you have to do when the pressure's on? And it clicked, right? Guys, if you're just dicking around on sim and you're trying to just make money and you're really not worried about it, you're not setting yourself up for success. So when you're on simulator, trade like it's live. And then when you flip that switch, you're okay. But one of the biggest things that happens here, guys, is when there's no risk. I'm so sorry, Cindy. I stopped just, I was going through a turn and I clipped my knee on the curbing and it stretched my ACL out. It didn't tear it, it just stretched it. And I couldn't really walk for about 6 weeks. And then I discovered I was fat, which didn't help either. So I bought a Bowflex, and that was the last time I rode a motorcycle. Guys, you have 100% confidence when there's zero risk. And the more risk you add, the more your confidence decreases. And there's a limit. There's a limit where you start making bad choices because you're over leveraged. Every hour in my life is comedy hour. But this is a pretty good picture. And John shared this in the other room. Ride a Harley, fat looks right. No, my motorcycle days are done. I love motorcycles. I had such a great time on motorcycles. I was even a motorcycle mechanic for years. I don't trust people on their cell phones. So Cindy, every time you take a trade on simulator, pretend it's real money. And then when you go to real money, and let's look at, I just want to see something real quick on your real money picture. And I think Jeremy, so big props to Jeremy on this one. Well, you're a 2-lot, you're okay. Can I show you one other thing about your trade? That's it, right? If it's going to go, it's going from there. It's okay to not give it all back. Lost the sound? Did everybody lose it? Give me a Y if you can hear me, guys. Cool. Yeah, and that'd be fun. So put the stop where the market shouldn't go, right? That's a pretty good lesson. And then one more thing, Cindy. If these triggers are flat, there's no momentum, because in order to have momentum, triggers have to be wide and angled in the direction of the trend. So when your large triggers really go flat like a deflated balloon, what happens is it's letting you know that immediate momentum, that small chart momentum, just really isn't there. It's not solid, and maybe that'll help you a little bit. It kind of confirms that we're losing momentum here. So good stuff. I'm not worried about you. You're going to be fine. Keep posted in the room. Keep annotating charts. Can you imagine? Here we go. Let me open it again. So imagine for a second, guys, everyone use your imagination. It's fun. Imagine that you're looking at this large chart, right? And the first question you ask yourself, Cindy, is, do I have momentum? What do you suppose the answer would be? Do I have the momentum I'm looking for to take a long trade? It's slowing. Not the best look, right? And then you say, do I have a clear path? So all you're doing is you're going through this checklist out loud in the room. I don't know the Spanish word for momentum or clear path, maybe entrado. So what you're saying is, do I have momentum? And then you're like, no, not really. And you're like, do I have a clear path? No, not really. And then you have to go back to that great lesson, Cindy. Strong triggers break areas. Weak triggers in an area are where that area is more likely to reverse. And that's one of the lessons that we talk about every day. So I encourage you guys, every time you talk about getting into a trade, I want you to recite this in your head. Do I have momentum? Do I have a clear path? Do I have an area inside of limpio? Is that clean? Limpio is clear? Okay. And Olympia is clean. Use that one in the restaurant a lot. So Olimpio is clear. I'm going to learn Spanish. You know, I was talking to someone today. He's trading from Canada, but he's Hispanic. I think he and John are gonna speak to one another about creating a Spanish speaking 101, which I think would be awesome. Because I think there's an awful lot of people where maybe the language barrier is a challenge. So, Ron, thank you for that. Guys, I had fun today. I feel like we got a lot of great lessons today.